Hello, my dear students. Myself, Professor Gaurav, and I'm here to do last day revision for you for financial reporting. I will be going through the important standards which we should obviously have a very good look at on the last day or a day before our exams. So friends, let me start with the revision for Ind AS 116. Now what is there under Ind AS 116 which I would like to discuss with you? Some 10 points. First of all, a lease. Then second, separation of lease. Then the key terms which we should remember: recognition and measurement, in books of lessee, recognition and measurement in books of lessor. Then my dear students, this is the point which I would like to discuss with you. Sublease, a very small area, but yes, we need to have a look on it. The seventh point, remeasurement. The 8th point, nothing but modification in a lease. The 9th point, sale and lease back. And of course last, normally we do talk about transition adjustment and all those things. Yeah, but here transition adjustment very important for us. So my dear students, these are the 10 points which I propose you to remember when you are going for your exams. So let us start with the first point, lease. So obviously what is a lease? Very good. Lease is a contract wherein the lessor conveys to the lessee the right of use of an asset for a particular period of time. Superb. It means there are two things in case of a lease. There has to be an identified asset and the right to control use of that asset. These are the two things which we have to see while identifying whether a contract contains a lease. Okay, now identified asset, what should we say? So in case of identified asset, it is explicitly mentioned or it may be an implicit in the lease. It may yet to be manufactured also. It's not necessary it would have been manufactured. Then within that identified asset, friends, we had discussed something known as supplier substitution rights. Means supplier, that basically lessor should not have substantial substitution rights. Supplier should not have substantial substitution rights. How can we say he does not have substitution rights? Number one, I can say he has substantial substitution rights provided he has a physical ability to substitute and he is going to get economic benefits from substitution. Then we can say supplier has substantial substitution rights. This was the first area with respect to identified asset. The second area is the asset is physically distinct. It means it should be independent. If it is capacity based, then substantial capacity should be with the lessee or the customer. Normally, when can I say substantial capacity is with the lessee? When the capacity of more than 90% is with us. Now, this is what was there with our concept of identified asset. Now, friends, in this, there was something which was very important, and that was two things. Protective rights are not to be considered. And the second part, if nothing is specified, the supplier does not have substantial substitution rights. If nothing is specified, then the supplier does not have substantial substitution rights. Yes, my dear students. So basically, if you look properly on lease, identified asset should be there. So for that identified asset, it should be explicitly mentioned, or it is implied, even though it may not be manufactured. Supplier should not have substantial substitution rights, and it should be physically distinct. This is what for identified asset. Now, right to control, the second area. Who has the right to control use of this asset? Now, who has the right to control? So, right to control should be with the customer, nothing but the lessee. Right to control use should be with the lessee, customer. And this right should be throughout the period of use. How can I say you are having right to control use? So I can say I have right to control use provided I am going to obtain substantially all economic benefits from that use of asset. Okay. And the next point, friends, is nothing but right to direct use. Customer will direct how to use, for what purpose the asset is to be used. All these things will be done by the customer. Here there was an important point that if the right is predetermined, then we have to check who has designed the asset, or who directs how to use the asset. In the sense, operating. So this is what was there, friends, with respect to our lease. Now coming on to the second area. What is the second area? Separation. Now under separation, first of all, multiple lease components. Should you separate multiple lease components in sense multiple assets? Yes, friends. If there are multiple lease components like fully furnished flat, then I need to do the separation. It is mandatory. It is mandatory. Separation is mandatory. Now, when can I say there are multiple lease components when lessee can get benefit from use of each of the asset, and those assets are not highly interdependent or interrelated, then and then only. So if there are multiple lease components, it is mandatory to separate. Then the second point was with respect to non-lease component. Now friends, what are the non-lease components? Nothing but maid services along with fully furnished flat, driver services with the car. So these are nothing but non-lease components. So what are we supposed to do? Nothing but we are supposed to allocate the payments between the lease and non-lease component in SSP, stand-alone selling price. Yeah, in ratio of course, in ratio of stand-alone selling price, we are supposed to do it. Now, there is a practical expedient. If it is practically not possible, so you can say that we will not segregate. To not separate lease and non-lease component. Okay. Now friends, one more point, very important point in this, that property tax, insurance are not non-lease components. So if we are paying any property tax, insurance and all those things, the lessee pays all those things, that should not be considered as non-lease component. This should not be considered as non-lease component. Clear? So it will get included in overall lease payments only. Okay, now moving on to the third area. So my third point, key terms which you should remember friends. First, the inception date. What is the inception date? The date earlier of two things. The date of the lease agreement or date on which all the important terms and conditions are decided. Yeah. This is the date, inception date. Decide whether it is lease or not a lease. Decide whether a contract contains a lease. And then we had something known as commencement date. This is the date from which accounting will start, commencement date. Date on which the asset is made available for use. That is commencement date. Then friends, lease term. I hope you remember what was there in lease term. Number one, I'll just write it down here. Non-cancelable period, the period for which the lessee or the lessor cannot cancel the lease, plus renewal period if it is very likely that the lease would be renewed, or termination period. Termination period is to be included only if it is very much likely that the lease will not be terminated. So this was nothing but our lease term. Friends, renewal and termination option depends on the assessment whether there are economic incentive to continue for the lessee. Now, it may happen that you might have included renewal period and subsequently it does not get renewed. So we need to go for remeasurement or vice versa. So that remeasurement concept we will learn later. So the lease term includes three things: non-cancelable period, renewal period, termination period. As far as termination is concerned, if the termination option is with the lessee, then obviously I will include it, provided it is likely that the lessee is not going to exercise the termination option. If the termination option is with the lesser, then it should always be included, because lessee cannot cancel it. If it is with the both, either lessee or lesser, then we can say it will be included. Okay, so now coming on to the another area, friend, lease payments. What are the lease payments? 5 things were there. I hope you remember. During lecture we used to write down all those things. So which are the 5 points? Fixed payments, very good, including in substance fixed payments, very good. What was the second point? Variable lease payments, superb. What are those variable lease payments? Sir, which are linked to a rate or an index, a LIBOR or consumer price index, that only will be included. So any variable payments which are not linked to any index or any rate will never be included in our lease payments. Exercise price, if it is very much likely that the option will be termination penalty, if it is likely that the lease would be terminated, then termination. Residual value guarantee. These are the things. Now friends, one more point, and that is nothing but if there are any lease incentives, so lease incentives will obviously be reduced from this. Amount paid by the lessor to the lessee. Okay, so this is our lease payments. So we completed inception date, commencement date, lease term, lease payment, and the last point, discount rate. What should be the discount rate to be used? Very simple. Lessor's IRR should be used. If lessor's IRR is not available, then lessee's incremental borrowing rate. Okay, so we have to discount it. So for that we are going to use the lessee's incremental borrowing rate. So this is all the things which we have for the important terms for lease. Now let us move on to the fourth area. Now my dear students, the fourth point what I was talking about. Recognition and measurement in the books of lessee. What are we supposed to do with respect to the books of lessee? The first thing, recognize right of use of asset and lease liability. These two things the lessee has to do. Recognize right of use of asset and lease liability. Done? There is nothing like operating lease. Okay, so we have to recognize right of use of asset and lease liability. No concept like operating lease is there as far as this is concerned. Now friends, next point there comes, and that is there is an exception to this rule, or I can say the lessee can claim exemption for non-recognition of right of use of asset and lease liability if it is a lease of low value item lease of low value item or short term lease. Short term lease, nothing but 12 months from the date of commencement. Low value item is not been defined. Of course, it should not be on lease by lease basis, but on overall basis you should say what is a low value item, but no definition has been given with low value item by the standard, and short term lease less than 12 months. Now if you go for this option, my dear students, that I'm going to use this practical expedient wherein I'm not going to recognize right of use of asset and lease liability, then what? Okay, then it's very simple, is as good as rent expense. So whenever an expenditure is incurred, you'll just use the word means expenditure in the sense you'll make a payment, so rent expense account debit to bank. Of course it should be on straight line basis or on any logical basis. If you go with a straight line basis and the lease payments are different, the difference between the amount recognized as an expense and the amount paid is nothing but recognized as lease equalization account. Okay, so this is what you are supposed to do. Recognition, recognize ROU and lease liability. Now the question arises, sir, at what value should we recognize this ROU and lease liability? Now my friends, very simple. Lease liability should be recognized at present value of the lease payments. Means it is measured at present value of lease payments. Now what is lease payments? We just learned all those 5 points minus lease incentives and present value. If we want to find out present value, we have to use the discount rate, nothing but IRR of the lesser. If there is not available, then incremental rate. Okay, so measured at present value of lease payment. This is nothing but initial recognition. Initial measurement, I will say, on the date of recognition. How to go with subsequent? We have to prepare the amortization table. Yeah. Opening balance plus finance charges minus payments, closing balance. But remember that amortization table, one important point, when are the lease payments made? If the lease payments are made at the beginning of the year, then my dear students, it should be opening balance minus payment plus interest, closing balance. If the lease payments are made at the end of the year, then it should be opening balance plus interest minus payments is equal to closing balance. This is what you should remember. Now coming on to right of use of asset. How it is to be measured? At what value will you measure right of use of asset? Very simple. Whatever is the lease liability, I am talking about initial measurement. Initial measurement should be at what value? Lease liability, whatever you would have found out, of course, plus lease payments between inception date and commencement date. Minus lease incentive, of course, between inception date and commencement date. Plus initial direct cost, the cost which we incur, plus present value of decommission, restoration, site removal and all those things. This is nothing but my initial measurement of right of use of asset. Initial measurement. Subsequent, very simple, sir. So what will be your subsequent measurement, my dear students? Superb. Very good. Nothing but whatever is the initial amount, from that we need to deduct the accumulated depreciation Hence we are going to charge depreciation. Now how much depreciation should you charge? It should be based on the economic life of the asset, provided the ownership of the asset will be transferred to the lessee. Then it should be based on the economic life of the asset, the benefit which you are going to get. But if the lessee is not going to take the ownership of the asset, then it should be based on lease term. So accumulated depreciation, accumulated impairment loss. So this all goes out. So what is left out is nothing but the closing balance. So remember, for depreciation, if purchase option is likely there that you are going to exercise the purchase option, then the depreciation period should be right for the years for which you are going to get the benefits, nothing but the economic life of the asset. Now coming on to the fifth point, my friends. What was the fifth point? Recognition and measurement in books of lesser. Now for lesser, the standard says we need to do the bifurcation, whether the lease is operating lease or finance lease. I repeat once again, for lesser we need to do the bifurcation, whether the lease is operating lease or finance lease. For lessee, there is nothing like operating lease and finance lease. It is always finance lease. Only for lease of low value item and short term lease, the lessee may choose an option that, sir, I would like to not recognize ROU and lease liability. Okay, that is okay. But for lesser, there is operating lease and finance lease. So first point what we have to discuss in the books of lesser, friends, is nothing but whether the lease is, identify whether lease is finance lease or operating lease. Now how do we identify? So there were 5 points. At the end of the lease term, ownership is going to be transferred. Very good. Number 2, at the end of the lease term, lessee has an option to purchase. Then number 3, the lease term covers majority of the economic life of asset. Fourth point, the present value of lease payments substantially covers the fair value of the asset. And the last is nothing but the asset is of special nature and can be used only by the lessee with some modifications. Nobody else can. So out of these 5 points, my dear students, any one point is satisfied, then we say the lease is a finance lease and accounting will be done based on that. But if the lease is an operating lease, the accounting will go the other way. Okay. So if it is a finance lease, what is the treatment you are supposed to do? Simple. Recognize lease receivable at net investment. Recognize the lease receivable at net investment. That is the most important area. And then you recognize finance income. Now the question arises, sir, what is net investment? Nothing but present value of gross investment is equal to net investment. What is gross investment? Nothing but all the lease payments, whatever we had mentioned in terms, and those 5 minus incentives, plus unguaranteed residual value accruing to the lesser. That is nothing but my net gross investment, and we have to just discount off that gross investment. Logically, friends, this net investment has to be equal to fair value plus initial direct cost. Means the reason is very simple. We say IRR. What is IRR? The interest rate at which present value of all inflows equals to outflow. So what is the outflow for the lessor? Basically nothing but you would have bought the asset. Say he buys the asset. So there is nothing but fair value plus IDC, initial direct cost. So fair value plus initial direct cost, that is nothing but your net investment, present value of gross investment, nothing but all the inflows which we are going to get, lease payments plus UGRV and all those things. Okay friends. Now moving further. So now my journal entry would be lease receivable account debit, initial measurement, nothing but present value of gross investment, that is nothing but net investment. 2, if I am purchasing and giving it, so nothing but a bank, or you can just write down asset. Any difference will be recognized as profit or loss. And thereafterwards, what will be happening? This is initial measurement and subsequent measurement. Again prepare, yes friends, amortization table. Now within lessor for finance lease, we had a case of is a manufacturer or dealer lessor. Okay, so there we used to recognize sales and COGS was also recognized, and profit, that is nothing but selling profit, was recognized. Recognize sales and COGS, obviously selling profit was getting recognized. That was the extra stuff what was happening as far as manufacturer dealer is concerned. Now friends, the next area, operating lease for lessor. What is to be done for operating lease in case of a lessor? Very, very simple. We recognize lease rental income over the lease term. And there is no initial recognition. And the second stuff what we do is nothing but recognize depreciation. This lease rental income is nothing but bank account debit to lease rental income. This should be recognized on straight line basis or any other method which is more appropriate with respect to the matching concept, economic benefits with the cost. If any difference comes, the difference you can just transfer it to lease equalization account, nothing but deferred rent account if applicable. Okay, so this is all about accounting in the books of lessor. Okay, the sixth point, sublease. What are we going to do for sublease, friends? Very, very simple for sublease. As far as sublease is concerned, the accounting is in the books of lessee only. Yeah, so there is something known as head lease and sublease. So I take an asset on lease and I, now original lessee, will give this asset to somebody on sublease. And remember, it is similar only. Now if it is sublease, then now I become a lessor. I have to check out whether the asset which I have given on lease is this on operating lease or a finance lease. This is what we supposed to do. So this accounting will be happening in the books of lessee only for sublease. But in this case, there is one important area which I want you to remember, and that was that when we check the third condition for this, whether the lease is a finance lease or operating lease, friends, lease term covers majority of the economic life. In this, lease term covers not majority of economic life, but it should be substituted with lease term covers majority of the previous head lease term. Yeah. Then if you have given an asset on sublease, head lease can never be a lease of a low value item. Then you cannot, as a lessee, I cannot go for the exemption. I repeat, if there is a sublease, I take an asset on lease, I give it on sublease to somebody, then my head lease, I can never choose the option that it is a lease of a low value item. Got the point? Rest all those things are simple only. If it is finance lease, then I will derecognize the asset. If it is operating lease, then I will not derecognize the right of use of asset. So this is all about your sublease, friends. If finance, no derecognition. Okay, so the next area for our discussion, point number 7. Now, in case of remeasurement, friends, what is happening is there is no change in the contract. So, no change is happening in the contract, but because of whatever are the terms and conditions decided in the contract, as a result of those terms and conditions, there is change in the cash flows which are happening. Or I can say there is a change arising on account of two things, two areas. Change in lease term, purchase option, and the other part, change in substance fixed payments, change in index, that is nothing but variable payments are changing, change in residual value guarantee because of change in the expected residual value. Now, because of this, what are we supposed to do? Nothing but simple, remeasure the lease liability. Using which rate? Remember, for this, revised discount rate. Remeasure the lease liability using revised discount rate, and of course the corresponding effect, friends, it will be on right of use asset. Here also remeasure the lease liability using original discount rate. Revised discount rate and original discount rate. Clear, my dear students? Okay. So, remeasurement, simple, no issues. Now coming on to the 8th point, and that is nothing but modification. Changes in the existing contract. If you remember, we divide the modification into two parts. Okay. Increase in consideration because of modification. Terms are changed, terms are modified. Increase in lease term. Increase in scope. Decrease in consideration. And the other stuff here, decrease in lease term, decrease in scope. Now, scope in the sense area. So what are we supposed to do if there is a modification, friends? Simple. Here remeasure the lease liability on the modification date with corresponding effect to, yes, tell me. Right of use asset. Remember, my dear students, there is no impact on P&L. Huh? So whatever is the change, it directly goes to your right of use of asset. Here, if it is decrease in the scope, then what are we supposed to do? If there is a decrease in a scope, standard says derecognize ROU and lease liability. Proportionately. And of course, the difference any will go to P&L. Here no impact on PL. Okay, so this is what, friends, was there all about modification. Modification means the change in the terms of the existing contracts. Okay, my friends, let us now move on to the next area, and that is nothing but sale and lease back, and the last transition adjustment will complete it off. Sale and lease back. Now there, if you remember, we did those 5 points one by one in sale and lease back. Here, first of all, we have to remember whether control is transferred, control not transferred. If control is transferred, then it is a sale under Ind AS 115. Control is not transferred, then it is nothing but loan. Now within that, friends, we learned that sale and lease back is at off market terms. If it is at off market terms, we should divide it into two parts. The selling price is more than fair value, or the selling price is less than fair value, or you can just say present value of actual rent is more than present value of fair rent. Here on the right hand side, I can say present value of actual rent is less than present value of fair rent. This selling price is more than fair value. It was nothing but hidden loan. And hidden prepaid rent. Hidden loan, financing arrangement. So what we used to do? Reduce the selling price by the loan element and here add selling price by prepaid rent. This is what we used to do. I hope you remember. Now I'll just write down the steps what we were there. So those 5 steps. Step 1. find whether sale and lease back contains off market terms. Second, calculate there is a certain present value of all agreed lease payments. Next, ascertain present value of dedicated lease payment. Now, what is your dedicated lease payments? Step number 2, that is nothing but present value of agreed lease payments, whatever is there in that, plus or minus of market terms. If it is loan element, as I wrote, reduce the selling price. If it is prepaid rent, nothing but we add it, plus or market of market terms. So what I get is nothing but dedicated lease payments. Thereafterwards, friends, we will recognize the right of use of asset. Step number 4. Recognize right of use of asset, of course, proportionately. Now, how much right of use of asset? So I have sold my existing asset. So the WDV of the asset multiply by present value of dedicated lease payments, the whole divided by fair value. Thereafterwards, recognize gain or loss to the extent of rights transfer. Now, normally we used to go in this way that journal entry we pass and the difference is nothing but gain or loss. But just we used to find out what is the gain or loss, nothing but selling price minus the WDV. Okay, selling price, or you can just say the fair value minus the WDV, 2 parts. Rights retained and rights transferred. Rights retained is nothing but gain or loss, whatever it is. Into present value of dedicated lease payments, the whole divided by fair value. And friends, this was nothing but balancing figure. Of course, when we did the question in our class, we found it through a balancing figure, but this is what we can do. Normally, I'll just say we can pass an entry only. What entry we can pass? Very simple. In case of sale and lease back, assuming that there is an off-market element which is nothing but financing. So bank account debit, the amount received. RU asset account debit, whatever I did ROU for step number 4. 2. Financial liability, nothing but hidden loan element. 2. The asset which is there in our books, the asset which is sale and lease back. 2. Lease liability. Lease liability, the same way what we have been recognizing. So here you will get difference, friends. This difference is nothing but gain or loss. Gain on transfer or loss on transfer. Okay. So this is all with respect to sale and lease back. Now the last point, or I can say the last area, which is nothing but transition. Transition means we are following our previous gap. Normally our I gap, that is AS 19, has been being followed, and now we are switching over to Ind AS 116. So what I am supposed to do? Of course, earlier people, those who used to follow Ind AS only, 17 was there, and then they were switching, but they were similar. Either you are following Ind AS 17 or you are following AS 19. The concepts were similar only. It says no need to check if arrangement contains a lease. Second, if previous lease is finance lease, then whatever is the carrying value, take carrying amount of asset as ROU and liability as lease liability. Okay, so if previous lease is a finance lease, then also, my dear students, there was no issue. It was very simple. If it is an operating lease, then we had three options basically: full retrospective, or modified retrospective. If I go with modified retrospective, I further have two options: alternative 1, alternative 2. If I go with modified retrospective. Now, if it is full retrospective, consider that the Ind AS 116 was applicable from the commencement date, and I should use the discount rate which is on the commencement date. If it is modified retrospective, then alternative 1, what should we do? Nothing but lease liability valuation is to be done. Lease liability is nothing but present value of future lease payments, and the rate should be on 1st April 2019. Clear, friends? If it is alternative 1, then present value of future lease payments right from 1st April 2019. This is the date on which 116 came into picture. Yeah. But what about ROU asset? If it is alternative 1, then what we will do is nothing but we will retrospectively calculate what should be the ROU asset right from the beginning, from the date on which the lease is happening, in the sense 1st April 19. And if it is alternative 2, then the ROU asset balance should be equal to your lease liability. I'll just write it down here. PV of future lease payments discount rate on 419 ROU retrospectively. Here ROU will be equal to lease liability. Yeah, so my dear friends, this is where I have ended up your transition adjustment. I'm transiting from AS to Ind AS. So what am I supposed to do? Okay, so full retrospective, modified retrospective, present value of future lease payments 1419 only, and here we will value the ROU retrospectively. Okay, so this is the end of our 116. I missed out one point. I will just add up before I end up the session for 116. If it is modification, we have to see whether it results into a separate lease. Means there is an additional right of use of asset is obtained, and that additional right of use of asset is at standalone selling price. Then that will not be considered as modification, but that will be considered as separate lease. So here, my dear students, this is what all about your lease. I just had missed out the modification. I'm just adding it up. Your 116 is over. Now starting with Ind AS 115. Revenue from contract with customers. Friends, the important point which we should revise for this standard is nothing but 5 steps, or I can say identifying the contracts, identifying performance obligations, determination of transaction price, allocating the transaction price over performance obligation. That is nothing but whatever amount of transaction price we have determined in step number 3, that amount will be divided on step number 2. Last, recognize revenue as and when performance conditions are fulfilled. Thereafterwards, friends, some special areas, nothing but repurchase option is there and all those things. Then friends, the appendix, service concession arrangement. Okay, so in all, I'm going to discuss somewhere around 7 areas for a quick revision of this chapter, that is 115. So let's start with the first area only, and that is number 1, identifying the contract. Okay, so whether we have a contract with our customers or not, that has to be identified. Now for that purpose, remember friends, what should be there. It can be a written contract, it can be oral, clearly expressed contract, or it can be an implied. But of course it should be enforceable by law. And the following points should be there. We should check whether the contract has following points. Now, what are the points that we should check, friends? Yeah. Both the parties are have approved. Both parties have approved and are committed to the terms. Rights and duties can be identified. Payment terms can be identified. then the consideration will be collected. There is a probability that the consideration will be collected. Now friends, and of course one more point I just missed out, the transaction has commercial substance. If all these things are there in the contract, then we can say if this 5 criteria, basically this 5 criteria is there, then we can say there is a contract with the customer and we have to recognize revenue with respect to this contract. Means first of all identify whether a contract is there or not. Okay. Now within this only step 1, I will talk about something known as combining the contracts. Should we combine the contracts with each other? There are multiple contracts done with a single customer also, or multiple customers and multiple contracts are there. Can we combine the contract? What does the standard say? Now basically 3 conditions we need to fulfill if we want to combine a contract. We can say it is negotiated as a package, entered into at same time, the consideration to be paid in one contract depends on price of another, and the goods and service are single performance obligation. Now what is that single performance obligation that we are going to learn, or I can say I'll revise while doing step number 2. So this is what our standard says. Okay friends. Now coming on to within step number 1, let's move on to modification. Now if the modification results in distinct goods and services, and that distinct goods and services are at standalone selling price only, then that modification is to be accounted as a separate contract. We are not going to make any changes to our existing contract revenue. I repeat, if the modification results in additional distinct goods or services, and those additional distinct goods and services have been priced at a standalone selling price, then the modification will be accounted as a separate contract. Okay, so now I'll just make a small chart for you which you should remember. We'll just ask, does the modification, now this is nothing but a modification which is not a separate contract. This is what I'm talking. Only affect the transaction price. Yes, my dear students, does the modification affect only the transaction price? You can have 2 answers. Yes and no. If it is yes, then again a next question. Are the remaining goods or services distinct? And if it is no, then we have one more question here. Does the modification add distinct goods or services. Then again we have two answers, friends. Yes, no. Then standard says account for modification prospectively. Whatever is the change, account for it prospectively. If it is no, then cumulative catch up. Account for modification as cumulative catch up adjustment. Or you can say, sir, we will apply a retrospective effect. Now again here, if it is no and also yes, if it is no, same cumulative catch up. Account for the modification as cumulative catch up. Now, does the modification add distinct goods or services? Here we will ask one more question. Yes. Does the contract price increase by the amount reflects the SSP for distinct goods? Yes, sir. It gives distinct goods and services, and that too at a SSP. Then it is nothing but a separate contract. If it is no, account for modification prospectively. Okay, my dear students. Now, you may just go through the whole chart. Yeah. Does the modification affect only the transaction price? Yes, no. Are the remaining goods or services distinct? Yes, no. If the modification does not affect only transaction price, then does it add distinct goods and services? No, sir, it does not add. Then it is a cumulative catch up. Yes, sir. Then we should again ask a question. What is happening? You are getting distinct goods and services, but are those distinct goods and services priced at SSP? Again, yes and no. So friends, this is all about our modification. So our step number 1 is over. Yeah, any doubt on this point? Obviously no. Thank you. Now friends, let us move on to the next area, and that is nothing but step number 2. What is our step number 2? Yeah. Identify performance obligation. How many performance obligations are there in the contract? So what is the performance obligation? Performance obligation is a promise to provide a single goods or services that is distinct or a series of distinct goods and services that are substantially the same and have same pattern of transfer. Now, when can you say the goods and services are distinct? Remember, friends, two things. We can say a particular goods and services are distinct if the customer can get benefit from the promised goods and services individually, and each obligation is separately identifiable from other obligation. Now for that I can add up 3 points which you should remember. When can we say each obligation is separately identifiable from from the other obligation? So number one, no significant integration of services. No significant modification or customization, and those services are not highly interrelated and dependent. Then we can say it is a distinct goods and services. Okay, friends. So this is my step number 2. Let us now move on to step number 3. Step 3 is nothing but determining the transaction price. What do you mean by transaction price? What would be the component of transaction price? Very, very important. You have to remember. See, step 1, 2, basics. It is nothing but just gives us a basic idea. But step 3, what is the transaction price? Step 4, allocating the consideration over the transaction price. And step number 5, when should I recognize this as revenue? These are the 3 very, very important steps. Let us start with transaction price. There are so many areas to be discussed within transaction price. Now friends, transaction price is the amount that the entity expects to receive, or it is entitled in exchange of goods and services, provided it does not include the amount which is received on third party. These are the basic things. Like if you have received GST, you should remember third party amount is not to be included. See, there were 4 factors which we had discussed. I'll just revise off all those 4 factors. What are the components? What are the components of my transaction price? The first was variable consideration. Then financing arrangement is there. That is time value of money, friends. Fair value of non-cash consideration. And the effect of the amount payable to the customer. Now, variable consideration, that is the first area and very, very important area from examination point of view also, my dear students. See, variable consideration has to be included if variable consideration is not constrained. It is not constrained, then only we will include variable consideration in our determination of transaction price. When can I say variable consideration is not constrained, my dear students? I can say variable consideration is not constrained only if it is highly probable that a significant reversal of revenue will not occur when the uncertainty is resolved. Yeah, I'll repeat. Variable consideration is included when it is not constrained. That is, it is highly probable that let's use the standard language only, that the significant reversal of cumulative revenue recognized will not occur when the uncertainty is resolved. Now friends, what are the factors that gives you an idea that it is not constrained? Or I can just go in this way. What are the factors that gives me an idea that the revenue is constrained? So, limited experience, certain factors which are out of my control, like dependent on the outcome of the case. If I win the case, I will be getting this much of amount. Yeah, factors are not within the control of the entity. The period is very long when we talk about whether the variable consideration will be received or not. So the period is very long. So when will that uncertainty get resolved? You say, sir, it's a very long period. I don't know. After a period of say a year or something more than that. Okay. So these are the constraints. So when there is no, I'll just come back. Determining the transaction price, 4 things are there: variable consideration, time value of money, fair value of non-cash consideration, and amount payable to customer. When we talk about variable consideration, friends, variable consideration should be included in transaction price only if it is highly probable that a significant reversal of the revenue recognized till date, cumulative revenue will not occur, then only. There are no constraints, then only. Now, how should this variable consideration be included? So, the standard says in this way, variable consideration will form part of over a transaction price based on two methods. Now, what are those two methods? Expected value method and the most likely outcome. Expected value method and most likely outcome. Now, what is that expected method? Nothing but sum of possibilities, probability weighted average. When should I use expected value method? When can I say multiple outcomes? So I will use expected value method. But when there are two outcomes only, then I will use the most likely outcome method. Okay, friends. So this is all about our variable consideration. Now, in variable consideration, what were those variable consideration? I'll just give you a gist of those. What can come in variable consideration? Nothing but volume discount, price concession, cash discount, rebate, price based on a formula, price protection, price matching. Okay, so this is what we can have in case of our variable consideration. Now, friends, the second area, nothing but time value of money. It means there is a financing component which is included here. So if there is any financing component that is included, then we need to bifurcate it between how much towards transaction price and how much towards that financing component. Yeah. If there is extended credit period, then we have to bifurcate between transaction price and finance income. The rate should be nothing but your IRR. Okay. Now there is a practical expedient you can use that if it is less than or equal to a year, then I will not say there is any financing element. Okay. Now the third area, there is nothing but non-cash consideration. Yeah, non-cash consideration, I will bifurcate into two parts. It lacks commercial substance then no revenue recognition is under Ind AS 115. If you remember, in class discussion also we had learned this area that one petroleum company is giving another petroleum company that you serve my customer in your area, I will serve your customer in my area. So it lacks commercial substance. So no revenue recognition happens. What we do is nothing but inventory balances are adjusted. But has commercial substance. Then it should be at fair value of that non-cash consideration received. If there is any change in the fair value subsequently, that does not mean we are going to change our transaction price. Fair value of the consideration received. If that is not available, then the standalone selling price of goods or services. If not available, then only, my dear students, otherwise not. Okay, so this is nothing but with respect to non-cash consideration. Moving on to the fourth area, the effect of consideration payable to the customer. The effect of the consideration payable to the customer. What should we do with respect to this? This also forms part of our transaction price. But remember, if I'm paying any consideration to the customer and I'm going to get any distinct goods or services, then it is nothing to do with our revenue recognition. Like I'm selling you goods and I just want an hoarding to be there at the entry point. So there is an hoarding advertisement kind of stuff at the entry point of the customer's premises. So I'm getting some distinct goods and services. If I'm going to get some distinct goods and services, my dear students, then it will not form part of my transaction price. I'll just divide it. I'll just make it easier. Just wait. The effects of distinct goods and consideration. So consideration payable to customer, two parts. For distinct goods or services, no distinct goods or services. If we are going to get distinct goods or services, you can just say the consideration is equal to fair value, or the consideration is more than fair value. Then what are we supposed to do? Very simple. If no distinct goods and services, the amount is reduced from transaction price, accounted as an expense separately, here what we should do, up to fair value it is an expense, above fair value reduce from transaction price. Okay, this is with respect to consideration payable to the customer. Now friends, we move on to our next area. There is nothing but step number 4, and that step number 4 was allocating the transaction price to different performance obligation or nothing but multiple performance obligations which have been identified under point number 2. That is nothing but step number 2. So in the step number 2, whatever performance obligations we have identified, what are we supposed to do with respect to that? Let us understand what are we supposed to do. The performance obligations, say multiple performance obligations are there. So what does our standard say? The transaction price is to be allocated between performance obligations in the ratio of standalone selling price, SSP, should be allocated in the ratio of standalone selling price. Now what is standalone selling price? Standalone selling price is the price the entity would sell the goods and services to the customer separately. Now for that we need to obviously estimate what is our standalone selling price in many cases. So standard talks about methods to calculate our standalone selling price. The best is nothing but the observable selling price of goods and services. And other methods, if standalone selling price is not available, then we should use other method. Otherwise, whatever is the observable data, this is the best option. First, we will always go with the observable standalone selling price, the price available for that particular performance obligation. If that is not available, then we have other methods. So there are 3 methods. Which are those 3 methods? Number 1, adjusted market assessment method. Nothing but we will always look at competitors' standalone selling price, similar product, what is the price of that? That is one way out. The second is nothing but cost plus margin. So whatever is the cost incurred for that particular performance obligation, on that we will add up our margin. And the last is nothing but residual approach. Nothing but your standalone selling price is the total transaction price minus sum of observable price of other obligations. So friends, this is all about our Step number 4. Yeah, only basic, whatever is the transaction price, that will be divided between the multiple performance obligation in the ratio of SSP. SSP available, well and good, not available, 3 methods are there. Now the question arises, sir, what about discount? What about discount and variable consideration, which are part of over a transaction price? Standard says that should also, discount as well as variable consideration should also be allocated in the ratio of standalone selling price only. But there is an exception, that if the discount pertains to the same goods, like I am having 3 performance obligation, and the amount of discount overall transaction price, that discount is exclusively for the first performance obligation only, then the discount should be allocated to that only. Similarly, variable consideration also should be allocated to that particular performance obligation to which it pertains to. So exception is there to allocation of discount as well as variable consideration. If variable consideration or discount pertains to a particular performance obligation, then the variable consideration and discount should be allocated to that particular performance obligation only. Clear? So this is nothing but our step number 4. Now friends, moving on to step number 5, nothing but recognize revenue as and when performance obligation are satisfied. So when should I recognize revenue? Standard says as and when performance obligations are satisfied, you recognize the revenue. Now revenue should be recognized when performance obligations are satisfied. Now when can we say performance obligation is satisfied? Performance obligation is satisfied when the entity transfers control of the promised goods or services to customer. Now when can you say you have transferred the control? Very simple, 2 conditions were there. The customer is only going to get benefit, substantially all benefits from that particular goods and services will be received by the customer. And the second, the customer can restrict access to others to those benefits. Then we can say control is transferred. Okay, that is a simple point. Now, this transfer of control can happen at a point of time or over a period of time. Now, when can we say that the control is happening at a point of time or over a period of time? And this should be done at the beginning only, at the inception only. We should identify whether the transfer, this control will be transferred over time or at a point of time. Now I can just give you an idea. When can you say that it is happening at a point of, see, these are not a condition, control of the underlying goods or services is at a point of time if these indications are there. I'll just say these are indicators. This does not mean that this should be fulfilled. Entity has right to receive payment. normally I can give a negative way out. If following conditions means over a period of time there are 3 points. If this is happening, this is happening, this is happening, then we say the performance obligation is satisfied over time. If none of the criteria which is given under over a period of time is getting fulfilled, it means it is at a point of time. Entity has a right to payment. Legal title has been transferred. Physical possession is transferred. Risk and rewards have been transferred. The acceptance from customer has been received. So these are some indicators which can give you that revenue is getting recognized at a point of time. Or here, over a time, number one. The customer simultaneously receives and consumes benefits. Or these are not indicators, these are nothing but the criteria. This is criteria. Second, the entity performance creates or enhances an asset. Which is controlled by the customer, or the entity's performance creates an asset which has no alternative use to the entity. But the entity has enforceable right for payment. Entity has enforceable right for payment. Now friends, if this is happening, then we can say it is over time. Here we can say normally at a point of time, when criteria under over time is not satisfied, which means the performance obligation is satisfied at a point of time. Okay, now friends, the question arises, if it is over a time, how would I measure the performance obligation? The next area of our discussion. How should we measure the performance? This is applicable in case of what? When performance obligation is satisfied over time. Final outcome can be estimated reliably. cannot be estimated reliably. If final outcome can be estimated reliably, what does it mean? It means we are able to calculate the profit or loss on that particular contract with customer. I'm able to determine what will be my work, what will be the cost incurred, and I can determine the final outcome. That is nothing but profit or loss, performance. Final outcome cannot be estimated. Now here the standard says if you cannot estimate it, then recognize revenue only to the extent of cost incurred. But if final outcome cannot be estimated reliably, then we should recognize revenue how much? So it says recognize revenue based on progress of each performance obligation, and that will be based on either output method or input method. Use output method or input method. Now friends, when I say output based method, nothing but based on survey, appraisal, all this. Input method, number of hours we can use, cost incurred, and all these things. Remember, if cost incurred does not result into actual progress of our work, then that cost should not be included in our measurement of how much work is completed. We had one question with respect to that elevators cost. So the cost of elevators was not considered for calculating percentage of completion. So number of hours and cost incurred and all those things. This is with respect to our step number 5, friends. Measurement of performance obligation. Now moving on to the next area, 6th area, special areas. Now, some areas, of course, basic areas related to this only, but certain more discussion is required. The first point we have is consignment arrangement. What are we supposed to do in case of a consignment arrangement? Yeah, so the consignee gets the possession, but the control over the goods is not transferred to the consignee. When the goods are transferred to the party on consignment arrangement, revenue should be recognized only when the goods are delivered to the third party, not now. Okay, so that was all about your consignment. The second area was bill and hold arrangement. In case of bill and hold arrangement, my dear students, what happens is billing is done, but the delivery is delayed. Maybe at the buyer's request, production schedule is not on time, something like that. In this case, what are we supposed to do is nothing but recognize revenue if the party, the customer has accepted the goods are available for delivery, immediate delivery, and the control has been transferred in sense. Then bill and hold arrangement is there, then we should recognize revenue. Provided it is substantive, that is nothing but the customer has requested for it. Sale with a right to return. Now what happens? In many cases we sell the goods and the customer has a right to return those goods. In lieu of that, the customer can get a credit or a similar good or a cash refund, as the case may be. Now, what we have to do is nothing but we have to do three things. We have to recognize revenue with respect to the goods which we anticipate that will not be returned. We should also recognize a contract liability with respect to the goods which are likely to be returned, and at the same time we need to recognize a contract asset. What is that contract asset? Nothing but the goods that are expected to be returned. So obviously if the goods are expected to be returned, those goods belongs to us. So when we are showing a contract liability, at the same time we are also going to recognize a asset also, right, to recover the goods. Then friends, we had something known as warranties. I'll take it on the next page. Now, warranties, will it be covered by Ind AS 37 or 115? Now, there we have to just remember whether the entity also gives an option to purchase the warranty separately. Yes, so we had a chart. I'll just revise of the chart what we had for warranty. Yes and no. If the customer has an option to purchase the warranty separately, then it is nothing but a separate performance obligation, and it will be under the principles of Ind AS 115. If it is no, then our next question comes. Does the warranty provides a service in addition to assurance? Again friends, we can have two parts. It also provides services along with assurance. Then friends, can I say again this is covered by Ind AS 115. Promise service is a separate performance. Obligation that will be covered by 115. No sir, there are no services provided. It is only assurance that our product will give you this much of benefit, some assurance. So then it will be accounted under Ind AS 37. Then it is nothing but a provision will be created for such warranty cost. If it is covered by 115, then what we are going to say, whatever is the contract, it has two performance obligation. It is sale of goods as well as warranty services, two performance obligation. And we will recognize revenue as and when that performance obligation is satisfied. Then my dear students, point number 5 is with respect to whether principal or agent. Means whether entity is acting in the capacity of an agent or entity is acting in the capacity of a principal. Say the nature of its promise is to provide the specified goods and services. Then I can say entity is principal. But the nature of its promise is to arrange for those goods and services provided by the other party. Then the entity is agent. If you remember, in our book we had one question with respect to tickets. One of the entities buying that air tickets. So if you're a principal, then recognize revenue on gross basis. And if you're an agent, then revenue is on net basis. That is nothing but your commission income. Then I move on to the next area, licensing. Point number 6. In this, remember, the license that provide access to intellectual property of the entity. In this case, obligations are satisfied over time. License that provide a right to use your intellectual property. Then we can say obligations are satisfied at a point of time. And here obligations are satisfied over a time. If you are having access to my intellectual property, then obligations are satisfied over time, and if you are having the right to use intellectual property, it is nothing but at a point of time. Now friends, the last area in the special area, in 7th area, nothing but our sale and repurchase arrangement. Now if it is repurchase arrangement, means you are entering into a contract wherein you are going to buy back your goods from the customer itself. So that is nothing but repurchase arrangement. Repurchase arrangement obviously can be two ways: a forward contract or an option contract. But within option contract, my dear students, there can be further two parts: a call option, wherein the seller entity has a right to buy back the goods, or a put option with customer. Now if I sell the goods and I'm going to buy the goods back, then two things: the repurchase price is more than the selling price today, or the repurchase price is less than the selling price today. I'm talking with respect to forward. If repurchase price is more than selling price, then we say it is nothing but financing arrangement. But if repurchase price is less than selling price, friends, it is nothing but a leasing arrangement. And accounting is to be done as a financing, that is, loan is to be recognized and expense is to be recognized. But if the repurchase price is less, then it is nothing but a leasing arrangement. Now that will apply to both forward contract and call option. We have to just compare whether the repurchase price is more than selling price and the repurchase price is less. Now what is to be done with the put option? I'll just make a small chart for your understanding. Is the repurchase price lower than original selling price? Either you will say no, sir. You'll say yes. If it is no, then repurchase price is more than expected market price. Yes, sir. Then obviously it is nothing but a financing arrangement. Okay, my dear students. Now next, yes. Then you have to ask two questions again. Is the repurchase price lower than the original selling price? Yes. Then does the customer have significant economic incentive to exercise? Again, here no, we should go for this only. Yes, no. If it is yes, repurchase price is lower than original selling price. Yes, sir. And you have an economic incentive to exercise. Account for contract as lease. No, sir, I do not have any economic incentive to exercise. So standard says very simple, recognize the revenue as and when performance obligation is satisfied with a right of return. Okay. So this is how our accounting for put option should be there. The customer has a right to put back the goods which we have sold to the customer. Now let's move on to another area, and that is appendix service concession arrangement. The last area, seventh area, appendix service concession arrangement. Now under this what happens? See, either you are going to get an intangible asset or you hold a financial asset. This service concession arrangement is pertaining to basically toll roads or any infrastructure facility which is developed on PPP model or a build, operate, lease, transfer, bolt model. Yeah. Now there are two parties, the grantor, the operator. When the grantor, or I can say when the operator receives consideration directly from the grantor, then what are we supposed to do? Recognize financial asset. I hope you remember, friends. We had one question. Jabalpur, Nagpur tollways and all this. The same, huh? When the operator receives consideration from the grantor. Now next. The operator has a contractual right to charge public a fee for use of service. Then what are we supposed to do? Recognize intangible asset. Remember, under no circumstances should the operator recognize the infrastructure facility as an asset. And whatever cost is incurred with respect to maintaining the facility and all those things, that will be expensed off to profit and loss account. Yeah. So appendix C, a very simple stuff. Recognize a financial asset or recognize intangible asset. So friends, this is all about our Ind AS 115. I would just like you to go through everything what we have done, though lengthy standard but a very conceptual standard. Somewhere around 7 areas which we are supposed to remember. Identifying the contract, then when can we combine the contract, modification, if modification happens, how modification should be accounted for, friends. Thereafterwards, step number 2, whether the goods or services are distinct. Okay, then what we had, step number 3, transaction price, and the transaction price had this many stuff. Money received on behalf of others cannot be there. Variable consideration based on two methods, expected value method and most likely outcome. If there are multiple outcomes, then we use expected value method. If there is two outcomes, two possibility, either I will receive the money or I will not receive, then the most likely outcome. Time value of money, non-cash consideration, consideration payable to customer. I hope you remember, nothing but some billboard will be there, something like that. So that will not be accounted only. Allocating the transaction price over the different performance obligation, we will use standalone selling price ratio. If standalone selling price is not available, then there are three methods: market assessment method, cost plus margin method, and residual method. Yeah, at this point, you remember discount and variable consideration. Discount and variable consideration will also be allocated between performance obligation in the ratio of standalone selling price, except when the discount relates to a particular performance obligation only, and that variable consideration also relates to that particular performance obligation only, then it will be adjusted with that particular performance obligation. Revenue is recognized when a performance obligation is fulfilled at a point of time or over a time. Measurement, output method, survey, appraisal, number of hours and all those things, input method. And then I did your special areas: consignment, bill and hold, sale with a right to return, warranties. Principal or agent, if you are principal, recognize revenue on gross basis. If you are agent, recognize revenue on net basis. Licensing, again, repurchase. As far as forward and call option is concerned, then in that case repurchase price is more, repurchase price is less. If it is put option, I had a chart for you. And thereafterwards, friends, service concession arrangement, the last area what we discuss. Okay, so friends, this is the end of our Ind AS 115, starting with Ind AS 103. business combination. Now let's revise of this stuff. Friends, what we are to learn in this chapter is, means what we are to revise in this chapter, first of all, what is a business combination? Thereafterwards, acquisition method, in which we have to learn 6 steps. Identify the acquirer, date of acquisition, identifiable net assets, purchase consideration, then within that non-controlling interest is there, and goodwill or gain on bargain purchase. Then we have reverse acquisition. Then we can just go through common control, which is nothing but our appendix C. And the last area, demerger and all those things. Okay, so let us quickly revise all these things, friends. What is the business combination? The first area, nothing but a business combination is a transaction in which the acquirer obtains control of another business. Okay, so it's a transaction in which the acquirer obtains control over another business. So there are two parties, acquirer and acquiree. When I say business, it is nothing but acquiree. Friends, business, what is a business? Let us define that business. And there is a concentration test also. I will talk about concentration test later on. Once I complete everything, then I'll come on concentration test. Business is nothing but input on which we apply process that results in output. It's not necessary that there has to be an entity only, then only it is a business combination. Even though there may be no entity, then also we can say this is a business combination. Of course, there can be an entity. I can acquire a business and that entity itself becomes a business for me. Many times I acquire an entity and that entity is not a business. Yeah, nothing but an investment entity is there. It is not having any inputs, process on which results in output. So first of all, we have to identify whether the transaction falls under the definition of business combination. Because the moment it falls under the definition of business combination, then only principles of business combination, that is 103, will be applicable. Yeah, so a business combination is a transaction in which the acquirer obtains control over the acquiree. Now, what can be a form of business combination, friends? So within this only I can say the structure of business combination. Yeah, the areas given by our standard is this. one or more business it becomes subsidiary of the acquirer, or the net assets of one or more business are legally merged into the acquirer. This is one form. Okay. So your one or more business becomes subsidiary of the acquirer, or the net assets of one or more business are legally merged into the acquirer. This is one way. The second way, one combining entity transfers its net assets or the owners transfer their equity interest to another combining entity or its owners. All the combining entities transfer their net assets, or the owners of the combining entity transfer their equity interest into a newly formed company. So this is the structure. In the sense, in exam when we are reading the question, we can get an idea. Okay, so this is a business combination. The fourth area is a group of former owners of one of the combining entity obtain control over the combined entity. Okay. So this is how a structure of business combination will look like, and this is the base on which we will say, okay, the principles of 103 will apply. Now remember, my dear students, 103 applies to the acquirer entity. Yeah. So whosoever is the acquirer entity, for them only these principles will apply. We are going to do accounting in the books of acquirer for business combination, either in SFS or in CFS. Okay, now going on to the method of accounting, the second area which we have already written here, acquisition method. Basically, there are two methods of accounting, acquisition method and common control. So both of them we are going to do, but within acquisition method, I will be discussing somewhere around 6 areas. I'll be revising quickly all those 6 areas. What are the important points? We will just talk on this. Basically, Ind AS 103, accounting for business combination, divides it into two parts. Acquisition method and common control. Now under acquisition method, as we wrote down all the steps, let us discuss each of them. The first is nothing but Identify the acquirer in the business combination. Now, who is the acquirer? Normally, acquirer is nothing but the entity which obtains control. Acquirer entity is an means acquirer is an entity that gets control in a business combination, and that's why it may happen many a times the legal acquirer may not be the accounting acquirer. That is the particular case of reverse acquisition. Yeah, but in this case, identify the acquirer in business combination. I'll just go with the simple way out. Acquirer is the entity which obtains control over the acquiree. Who obtains control? Normally, you can say that you obtain control. When do you obtain control? Normally, those who get the net assets, those who issue shares, and all those things, that will be considered as acquirer. Yeah, that is in normal case that will be considered as acquirer. But remember, friends, sometimes we can say that the legal acquirer is not equal to accounting acquirer. Normally, legal acquirer entity that discharges purchase consideration. Accounting acquirer entity which has control over the combined entity. Generally, the legal acquirer will be equal to accounting acquirer. The normal acquisition. I buy your business. But in some cases, legal acquirer will not be equal to accounting acquirer. This is nothing but reverse acquisition. This will be referred as reverse acquisition. Okay, so that I will be dealing it later, not now. So first identify the acquirer. Thereafterwards, friends, the second step for us is nothing but the date on which the accounting principles of 103 will be applied. That is the day on which initial recognition of NCI will be done. Non-controlling interest at fair value or at proportionate share of identifiable net asset, that will be done. That is nothing but the date of acquisition. Yeah. So what should be the date of acquisition? Standard says the best is nothing but date on which control is obtained. The day you get controlled over that entity. Yeah. Something can also give you an idea that, sir, by reading the question, we can say normally the date on which more than 50% of equity interest are obtained. Or you can say, this is the best, friends? This is the best. Date on which acquirer transfers PC. Or you can say, date on which acquirer assumes the net assets of the acquiree. Now, in this case, if you have to remember that the approval from statutory bodies is there, is just a formality. Then that is not the date of acquisition. But if approval is compulsory, then date of approval is the date of acquisition. Okay, friends. So this is all about our step number 2, date of acquisition. See, this is the date on which generally entry is passed. For examination point of view, the debate does not happen. Just I'm writing it here. Now moving on to the C point. It is nothing but identifiable net assets. Now see, you are going to acquire the assets. So what are the assets at what value, and of course the liabilities at what value is to be measured. Standard list it out in this way. Now under identifiable asset, I'll divide it into, I can say, 7 parts. Fair value of identifiable asset acquired, deferred tax asset and liability, reacquired rights, indemnification asset, fair value of liability assumed, fair value of contingent liabilities, now friends, one more, you can add up fair value of retirement benefits and many things. Okay, now just putting it within 7 points. Fair value of identifiable assets acquired. What does the standard say? It says that though the assets might not be there in the books of the acquiree, the same will be recognized in the books of acquirer at fair value. So whatever assets which are part of our business combination will always be measured at fair value. The assets might not be there in the books of the acquiree, still you can put a fair value. Then deferred tax asset and liability, of course it is in relation with Ind AS 12. What happens is we are going to recognize the assets at fair value, but as far as tax is concerned, in tax that fair value will not be considered. So obviously there will be the difference between carrying amount and tax base of that particular asset which we are acquiring in a business combination. So in a business combination, whatever assets, whatever liabilities are getting acquired, there will be difference between the carrying amount and the tax base of those assets and liabilities. For that we need to create deferred tax asset and deferred tax liability which are arising on account of business combination. So obviously very simple, carrying amount of asset is more than the tax base of the asset, then what we say, it's nothing but taxable temporary differences, DTL will be created. Carrying amount of asset is less than tax base of the asset, then DTA will be created, and vice versa. So here we have to compare what? The value at which we are taking the asset and liability and the tax base of that asset and liability. Of course, how to calculate tax base, that is in accordance with the principles of Ind AS 12. Reacquired rights. Now reacquired rights are nothing but the rights in sense I have given you some license and you are using the license. What happens is I acquire your business. So when I acquire your business, the license again comes back to me. That will be referred as reacquired rights, and these reacquired rights are to be measured at its fair value. Indemnification asset. Now what is indemnification asset? Indemnification asset is nothing but the standard says that say for example, if I take up a contingent liability from the acquiree, means I agree to that contingent liability, acquiree also promises me to compensate for any loss which I may suffer because of that contingent liability. So that amount of promise by the acquiree against that contingent liability is referred as indemnification asset. Even indemnification asset is to be recognized in our financial statements. This indemnification asset will be measured at lower of what? The amount promised or the fair value of contingent liability. So remember, lower of fair value of contingent liability or the amount promised. So this is all about our indemnification asset. Then we have fair value of liability assumed. Fair value of liability assumed, whatever are the liabilities in the financial statements of the acquiree that have to be measured using fair value, including retirement benefits also. Yeah, fair value of contingent liabilities. Now, as far as contingent liability will be concerned, it may be a present obligation arising as a result of past event but not recognized in the financial statements, because either the amount cannot be measured or the probability of outflow of resources is less than 50%, or that contingent liability will be a possible obligation arising as a result of past event, the existence of which will be confirm of occurrence or something like that in days 37. So this contingent liability will be measured at its fair value. Whatever it is, we will take it at fair value. So though we will use the word contingent liability, friends, but it will be there in the balance sheet of the acquirer entity, because it is acquired in a business combination and against which we might be having a indemnification asset. Now comes within this only, there is another area, and that is nothing but measurement period. Now, what is this measurement period concept basically? It says that these net assets, identifiable net assets, should be measured at fair value, but it may happen that the fair value is not getting determined very easily on the date of acquisition. So standard says, okay, what you do is nothing but take the values at provisional amount, provisional value of assets and liabilities, and as and when you get additional information, bring it at its fair value. So now this measurement period, I can say changes in values, or I can say changes in provisional value. That would be more appropriate. So if there is any changes in provisional value, we'll divide the discussion into two parts: within 12 months, after 12 months. If changes in values is after 12 months, then not covered by 103, we need to take care means of the changes in value as per appropriate Ind AS. But is it within 12 months, then two parts: conditions exist on date of acquisition, conditions do not exist on date of acquisition. Friends, if condition is existing on the date of acquisition and condition do not exist on the date of acquisition, then what am I supposed to do? If condition is existing on the date of acquisition, then obviously change in net assets will have effect on goodwill or gain on bargain purchase, and change will be accounted as per relevant Ind AS. Okay, as far as measurement period is concerned. Okay, my dear students, so this is with respect to our step number 3. Let us move on to step number 4. Now under purchase consideration, friends, it is our step number 4. We will discuss fair value of assets given up, fair value of equity instruments issued, fair value of contingent consideration, fair value of deferred consideration, and share-based payment awards. Now this is our total PC. Now friends, let us discuss each of them. These two very simple: fair value of assets given up. So whatever is the fair value of the assets which we are giving it to our acquiree entity, that will be forming part of my purchase consideration. Okay, so that amount should be at fair value. Now difference between the book value and fair value in the books of the acquirer will be nothing but profit or loss. Second is fair value of equity instruments issued. So whatever are the equity instruments which we are issuing as a part of our business combination, that will be recognized at fair value. Obviously securities premium and all those things will come. Now comes fair value of contingent consideration, something which is contingent. Now this point has to be discussed of. Okay, so fair value of contingent consideration. In this, we should divide our discussion into two parts. It is payable to the shareholders of acquiree. It is payable to employees of acquiree. Contingent, something which is not fixed, yeah, uncertain. That is nothing but contingent consideration, something which is uncertain. Now it is payable to the acquiree entity. Then it is treated as part of purchase consideration and measured at its fair value, of course, on date of acquisition. Now friends, remember, this contingent consideration can be a financial liability or equity. If it is financial liability, subsequent measurement will also happen at its fair value, and any changes in the fair value of contingent consideration will be routed through profit and loss account. But if this contingent consideration is not a financial liability but it is equity, then no remeasurement will happen with respect to this contingent consideration. Now payable to employees, I'll just take up here. Now if it is payable to employees, I'll divide it into three parts. Based on achieving target, based on service conditions, or it is based on target as well as service conditions. Now friends, if it is based on target consideration, it will be forming part of purchase consideration. If it is based on service condition, it will not be included in PC. If it is based on both target as well as service condition, friends, then we'll bifurcate as service term is more or equal to target term, or target term is more than service term. Now service term is more than target term, not to be considered as PC. It will not form part of my PC. Hmm? If it is not form part of PC, it means what? It is nothing but employee benefit expense. It is nothing but employee benefit expense. But if target term is more than service term, means the period in which you have to achieve the target is more than the period for which you are supposed to be there in the part of the entity, then it will be treated as PC. Now, if it is treated as PC, friends, then the question arises whether that amount what we write down to fair value of contingent consideration, whether that contingent consideration is a liability or that contingent consideration is equity, that we have to decide. If contingent consideration is a liability, then it will be remeasured every subsequent measurement date, every balance sheet date, it will be remeasured, and the changes will be through profit and loss account. But if it is recognized or classified as equity, though for that we have our financial instruments, that concept fixed to fix. If it is equity, then it will be not be remeasured. Then whatever amount is there, that only amount will be considered for the purpose of contingent consideration. Clear? Now point number 4. This was our point number 3, fair value of contingent consideration. Yeah, I'll just bring the whole chart on one page. Okay. Now, my dear students, the next point is nothing but deferred consideration. Very simple. Now, see, contingent consideration things were question mark. What was question mark? How much amount will be payable? Whether it will be payable or not? That is nothing but contingent consideration. But deferred consideration means certain. Under deferred consideration, it is certain that I am going to pay you this much amount. But when I am going to pay, I am going to pay you after some period. That is known as deferred consideration. So if it is deferred consideration, what we are supposed to do is nothing but bring it at its present value. That's why I have written here present value. Sorry, it's not fair value. Present value of deferred consideration. Kindly rectified. Present value of deferred consideration. Now comes share-based payment awards, the 5th point. Now, when we go for share-based payment awards, we are talking with respect to replace awards. You can have two kind: acquirer entity replaces the share-based payment scheme of acquiree entity with its own share-based payment scheme, or acquiree entity modifies the share-based payment scheme of acquiree entity. So this is what two stuff we have to discuss: share-based payment award, acquired entity replaces, and it does not replaces. Moving on to the first part, we can say SBPP, share-based payment scheme, which is a replaced. It means we are replacing our scheme with acquiree entity scheme. We divide our discussion into two parts with respect to expired portion, with respect to unexpired portion. As far as expired portion is concerned, friends, nothing fair value of old share-based payment scheme, of course on date of acquisition, divided by original vesting period or revised vesting period, whichever is higher, into the expired period. Now whatever amount you get here, this amount is considered as PC. And for this unexpired portion, this is nothing but a PC. Now this unexpired portion, what we do is nothing but fair value of the replaced plan. Less amount considered, this amount. So amount considered as PC, we reduce it, and then whatever comes here, this amount is considered as employee benefit expense over the remaining vesting period. Okay friends, so this is all about your share based payment plan which is replaced. Okay, now as far as employees of the acquiring entity are going to get shares of the acquiring entity only. Here what I wrote down here, this never forms part of our PC. Okay, so if acquiring entity modifies the existing share based payment plan, then it is not going to form part of PC. So if it is not replaced, everything is same. Yeah, whatever is X, that X, instead of I will say PC, I will say it is to be considered as NCI. Okay, nothing more. I repeat once again, the share based payment plan is not replaced. What is the acquirer entity doing? It is just modifying the scheme of the acquiring entity. So obviously nothing is going to form part of your PC. So same thing, share based payment plans not replaced. Expired portion, unexpired portion, everything is same. You just remember it. Fair value of old share based payment plan on the date of acquisition divided by this. Yeah, and that amount is considered as, okay, I'll write it. Okay. So share based payment plan not replaced. Expired portion means the period for which services are already rendered. Unexpired portion means the period for which the employees are required to render services. Fair value of the existing plan on date of acquisition divided by revised vesting period or original vesting period, obviously whichever is higher. Into expired period. So whatever you get, this is treated as NCI. Now friends, fair value of the modified plan, because you have made some changes in the plan, there is nothing but a fair value of the less amount already considered. So this is employee benefit expense to be recognized over the we'll say fair value of existing plan. Yeah. Okay, so not replaced, of course, it does not form part of PC. And if it is replaced, then it is going to become part of our PC. Clear? So this is all with respect to PC, friends. Now within this, one more important point. Separate transaction cost. Now what is that separate transaction cost? Friends, it is nothing but a amount paid which should not form part of your purchase consideration. Yeah, this amount would have been paid on account of non-contractual relationships, or this amount is paid on account of existing contractual relationship. Like say for example, yeah, separate transaction cost. This separate transaction cost, I'll divide it into two parts. In case of non-contractual relationship, in case of contractual relationship. If it is non-contractual relationship, it will be measured at its fair value of settlement. And if case of contractual relationship, like franchisor, franchisee, I'll just connect it with reacquired rights. So what happens? You have already have some rights. I have given you rights, and thereafterwards I purchase your business. So obviously the rights which I had paid earlier again comes back to me. Those rights are referred as reacquired rights, will be measured at fair value in the books of the acquirer entity. But obviously I need to pay you compensation because my existing contract gets cancelled. So if I pay you compensation, it will be measured at lower of fair value minus carrying amount or settlement amount. Clear? So this amount which is paid as separate transaction cost will not be included in our purchase consideration. Now friends, we go to our, see, if you remember, we are on acquisition method, identify acquired, these, now non-controlling interest, NCI. It refers to the amount of stake which is not held by the acquirer entity. You got control, but you still hold 60% of the shares only, or 70, something like that. It pertains to the amount which is not held by the acquirer entity. That is nothing but non-controlling interest. Now, as per Ind AS, this non-controlling interest is to be measured at initial recognition, I can say. Initial recognition of NCI can be in two ways. Either proportionate share of identifiable net asset or at fair value. So whatever is the INA on the date of acquisition, that much INA into whatever stake of NCI is there, that we will take. Initial recognition of NCI is at proportionate share of INA or at fair value on the date of acquisition. And this is initial recognition. It is not subsequent recognition. Subsequent recognition does not come into picture under 103. 103 only talks about initial recognition of our non-controlling interest. Obviously, then comes this last step, that is goodwill. Now friends, here I can just pass an entry to explain you goodwill or gain on bargain purchase. Nothing but see what entry I am going to pass. I have taken assets, so INA account debit. This was it as per step number 3. 2. Purchase consideration, whatever I would have given, step number 4. 2. NCI. Now this NCI will be as per step number 5. This is the journal entry to be passed in our CFS basically. It may be passed in SFS, rarest of rare cases, only in case of an absorption, but in CFS, this journal entry is passed in CFS. See, in SFS, your entry would be nothing but investment account debit to whatsoever. Now, INA account debit to PC to NCI. Now, the moment we pass this entry, there will be some difference which will come. This difference, if it is here, it is referred as goodwill. If it is here, it is referred as gain on bargain purchase. Now, this goodwill will be depending on the difference here and this gain on bargain purchase. Instead of writing in this manner, normally what we do is nothing but we just write down in this way: purchase consideration plus NCI. Now, if NCI can be at proportionate share of INA or it can be at fair value. From this, we deduce INA on date of acquisition. A positive figure is nothing but goodwill. A negative figure indicates gain on bargain purchase. Now, understand. If NCI is at proportionate share, then what we get is partial goodwill. But if NCI is at fair value, then what we get is nothing but full goodwill. The whole acquiring entity's goodwill is being shown here. But is it proportionate share? Then the goodwill is nothing but partial goodwill. One more point I can add: gain on bargain purchase will be recognized as capital reserve only, when we translate it to capital reserve only, transfer to capital reserve. But if it is distress sale, then this gain on bargain purchase will be transferred to capital reserve, but through OCI. Okay, gain on bargain purchase obviously transfer to capital reserve. It is recognized as capital reserve directly through equity. But if it is distress sale, then it is not recognized through equity, but it is recognized through OCI. Means from OCI it will go to our equity, that is other equity, statement of changes in equity. There is where it goes. Here, my friends. Okay, so this is all about our 103 acquisition method. Now comes reverse acquisition. What are we going to do with respect to reverse acquisition? Before I go for reverse acquisition, friends, I would just like to add one point here. And that is nothing but fair value of previously held interest. Nothing but if there is step acquisition. Step acquisition means what? I already have shares in your company and I buy further shares in your company. That is nothing but step acquisition. So if there is something known as step acquisition, then what are we supposed to do? Nothing but we are going to value the existing equity interest in the acquiring entity at its fair value. So in journal entry, it will go in this way. If I pass the journal entry, the stuff will be here to investment in acquiring. Of course, at fair value. This will be at fair value. So whatever existing investment is there, that will be credited in our books, and goodwill or gain on bargain purchase will be recognized. Okay. So if it is step acquisition, means I'm already having the shares, I buy additional stake which gives me control. Yeah. So that is to be considered. Now moving on to reverse acquisition. How should reverse acquisition be considered? Now friends, in case of reverse acquisition, we have a scenario wherein the legal acquirer is not equal to accounting acquirer. Legal acquirer and accounting acquirer are not same. Okay. Now remember the most important area of our discussion here and to for exams, and that is accounting will be done books of legal acquirer. Yeah. But from the perspective of accounting acquirer. Now, if you look from examination point of view, types of question. For reverse acquisition, can be an amalgamation, or it can be absorption. Now, if it is amalgamation, my friends, what can happen? Say A and B are amalgamated. To form C Limited, and A Limited gets control over it. In case of absorption, X is taken over by Y Limited, but X Limited gets control over Y Limited. Now, what should we do for the question answers? So, you should remember steps to solve question on amalgamation. If it is amalgamation, what are we supposed to do? First, step 1, we will identify the acquirer. The same thing. Who is the legal acquirer? Who is the accounting acquirer? Accounting will be happening in the books of legal acquirer only. That is nothing but here C Limited only. Journal entries will be passed in the books of C Limited, but from the perspective of A Limited. Step 2, date of acquisition. Step 3, fair value of net assets of accounting acquiree. Remember, fair value of net assets of accounting acquiree. Step 4, purchase consideration for accounting acquiree. Of course, this purchase consideration is a deemed purchase consideration. And of course, the last point we get goodwill or gain on bargain purchase. So your journal entries in the books of C Limited goes INA account debit to the equity share capital to other equity. So what we are doing is nothing but we are recognizing the INA of A Limited and B Limited at book value. Then C Limited will also pass an entry with respect to purchase consideration which it has given. I'll just write down the entry so that it becomes simpler also. Now in the books of C Limited, what we are going to do is nothing but we are going to bring non-current assets, or I can just say it's current assets. Liabilities, equity share capital to other equity. Now all these things will be happening at book value. Recognize balance sheet of, in my question, A Limited, that is accounting acquirer at book value. Then what is the next? Again, assets, account debit to liabilities to purchase consideration, that is deemed PC, and recognize asset liability of B Limited, that is acquiree, at fair value, and the difference will be goodwill or capital reserve. Okay, this will be with respect to our amalgamation question. Now if it is absorption question, what are we supposed to do if it is an absorption? Now friends, very simple, it is also going in the same way. We are having two parties, acquirer and acquiree. So in case of absorption, all my steps will remain same, but what we will do is de-recognize balance sheet of accounting acquiree, basically legal acquirer. Recognize balance sheet of accounting acquirer, obviously at book value, and then recognize asset liability of accounting acquiree at fair value, of course along with PC. Whatever is the purchase consideration, that has to be considered. So basically if you look properly, the case what we had here friends was this: X is there, is taken over by Y Limited, and X Limited gets controlled. So X Limited is there, Y Limited is there. X is getting control, Y is taking the business of X, but X is getting the control over Y. So what is this? This is nothing but accounting acquiree. I'll do it here. X Limited, Y Limited. Legal acquiree, legal acquirer. Accounting acquirer, accounting acquiree. Now Y Limited takes over business of X Limited. Y is taking over business of X Limited. So in the books of Y Limited, accounting will be done. but of course from the perspective of X Limited. So first, what did I say? Derecognize the balance sheet of accounting acquiry. So Y Limited balance sheet will be derecognized. Then recognize the balance sheet of accounting acquirer. X Limited balance sheet will be shown. Everything should be brought in the books at book value. And then recognize asset liability of accounting acquiry at fair value along with PC. Yeah. So this is all about our reverse acquisition. We had 2 questions in our book also, and we also did some examples in our classroom. Same thing. Now friends, let us move on to common control. Common control, basically a transaction wherein the control is same. That is before business combination and after business combination, you'll find whosoever was controlling the entity is the same person controlling later on. Like we had, say, X Limited was having 2 subsidiaries, say Y Limited and Z Limited. That was the scenario before business combination. After business combination, it goes in this way. X Limited holds YZ Limited. It means who was controlling Y earlier? X Limited. Who was controlling Z? X Limited. And the same YZ, this is nothing but combined entity, is again being controlled by X Limited. Then it is referred as business combination. This is referred as business combination in the nature of common control. Hence, if it is in common control, so we have a carve out in sense it is carve out to IFRS 3. Common control transaction is accounted using not acquisition method but pooling of interest method. Now under pooling of interest method, what happens? All assets, all liabilities assets, liabilities, reserves and surplus are taken over at book value. You'll always find that your INA will be equal to share capital. The difference between PC and INA, basically share capital, is adjusted through capital reserve. So the question of goodwill will never arise. Okay, now in this, friends, what are we supposed to do? The same thing what we did. Step 1, identify the acquirer. Step 2, date of acquisition. Step 3, INA, which obviously we are not supposed to calculate. Why? Because INA is always equal to share capital. Step 4, PC. Step 5, if 100% has been considered here, we can say, sir, NCI will not come into consideration. Step 6, not goodwill or capital reserve, but only capital reserve. So we can directly start with a question wherein we can pass an entry that whatever was there earlier is also there later. Now this is all about your common control, not a big stuff. Now friends, the last area, demerger. Now demerger can take a nature of sale of division, or it can take a nature of spin-off, or the plain vanilla demerger. What's happen? What is happening is existing company is selling off its division, new company is acquiring the division, or an existing company is acquiring the division, or the existing company is transferring its division to another existing company. So, what are we supposed to do? Sale of division. So, obviously, the other entity is nothing but our buyer entity. For them, it is a business combination. But normally, we focus more on spin off and demerger. Now, here what happens? We are already an existing company, say X Limited, and we have many divisions and something like that. We are transferring one of our division here to Y Limited. This Y Limited is referred as resultant company. Y Limited is nothing but resultant company. X Limited is nothing but demerged company. Now friends, how should accounting be done with respect to this demerger? PC is paid to whom? This is what we are going to focus. PC is paid to X Limited, or PC is paid to the shareholders of X Limited. Because normally when it is paid to X Limited, we say it is demerger. If it is paid to shareholders of X Limited, it is referred as spin-off. Now I'll just write down the accounting. Accounting for demerger in the books of demerged company. Understand friends, we are not talking for Y Limited, we are talking for X Limited, which is nothing but demerged company. Here what can be the accounting treatment? Two parts. PC is received by demerged company, or PC is received by shareholders, or I can say members of demerged company. If PC is received by demerged company, then see what would be the accounting? Liabilities which are transferred, so liabilities account debit. Resultant company account debit to assets. Difference can be here also, can be here also. Then next we will receive, so investment in resultant company will receive the PC to the resultant company. But if PC is received by the members of resultant company, friends, then it goes in this way. Liabilities account debit. Obviously all these are at book value. This is book value. Asset is at book value. This is resultant company's PC. Liabilities account debit, book value. Resultant company account debit is PC to assets which have been transferred off to members of resultant company, because whatever we are going to members of demerged company, whatever we are going to receive will be transferred to them only. Then obviously there will be some difference. And here when you receive the PC, members of demerged company to resultant company. Okay friends, this is what we are supposed to do as far as accounting is concerned. Now the question arises, what to do with respect to the difference? Now this difference, whether the difference is on the left hand side, this difference, or this right hand side difference. Difference, if acquisition method then difference will be adjusted through reserves and surplus. If common control transaction is this is a transaction of common control, then it will be accounted or it will be adjusted through capital reserves. Okay, then friends comes books of resultant company. What should resultant company do as far as this is concerned? Very simple. Resultant company will say assets, account debit. This can be at book value or it can be at fair value. To liabilities, book value or fair value. Why fair value? If it is acquisition method, then it will be fair value. If it is common control, it will be book value. To purchase consideration, whatever you have given, the difference will come on this and this. What should we do? Difference, goodwill in case of acquisition, goodwill or gain on bargain purchase in case of acquisition method, and capital reserve in case of common control. Okay, so this is what is all about your business combination chapter, friends. Moving on to next Ind AS, that is Ind AS 110, consolidated financial statements. Now friend, under consolidated financial statements, what we plan to do is nothing but I would like to revise the concept of control, then the consolidation procedures, upstream and downstream transactions, then we have something known as dividend adjustment, followed by revaluation adjustment, then chain holding, triangle holding, foreign subsidiary. Yeah, these are the points which we have already discussed while in the lecture, but we will just revise all those things very quickly. Foreign subsidiary, then there is purchase of additional stake after control is achieved, then sale of stake, which results in loss of control, which does not result in loss of control, exemption from then friends we have Ind AS 28, that is nothing but accounting for investments in associate and joint venture, and the last item, that is Ind AS 111, which is nothing but joint arrangement. So friends, if you look properly, there are 13 areas which should be revised off quickly, one by one. Okay. So concept of control, consolidation procedures, upstream, downstream transactions, and all those things. Let us start with control. What is the concept of control? See, under business combination, we learned a business combination is a transaction that was in 103, wherein the acquirer obtains control over the acquiree. 103 is our initial recognition and 110 is our subsequent recognition. So whatever principles were established by 103 business combination, that is carried forward through 110. Now my friends, what is the concept of control? When can you say you have control? So those three conditions, I hope you remember. An entity has control over another entity. If, what are the three conditions? Investor, that is, the acquirer has power over investee. Investor has exposure or rights to variable return. And third, investor has ability to use its power to affect the amount of variable returns. Now, what does power mean? Power means you have some existing rights which gives you current ability to direct the relevant activities. That is nothing but power. All relevant activities, that is nothing but all kind of strategic level activities. So power is nothing but something which gives you current ability to direct, or you have existing rights which gives you current ability to direct relevant activities, important activities. That is nothing but power. Then comes, sir, you are exposed to. When I talk about rights, honestly, I missed out that point. You have existing rights. Which rights? Substantive rights. Protective rights are not to be considered. Protective rights are not to be considered. You cannot take additional capital over and above this unless and until you take an permission from me. These are in the nature of protective rights. Protective rights are not to be considered. Now, the next point is nothing but exposure to variable returns. This variable returns basically in form of dividends, interest, or change in the value of investment. You are exposed to those variable returns. And the third point, you have ability to use the power to affect the amount of variable returns. It means you are not working in the capacity of an agent. You can use this power to impact your variable returns. So this was basically control, friends. I hope you remember. We did so many of questions which were theoretical based questions, but okay, more about theory. Now coming on to the second area, and that is nothing but consolidation procedures. What are the consolidation procedures? How to do consolidation? So how do we do consolidation, friends? Very simple. See, we are given the balance sheet of the parent and subsidiary. The balance sheet date is obviously different from the date of acquisition, because if it is date of acquisition, then the principles of 103 will also come into picture. That is only comes. So what are we supposed to do? We are supposed to do consolidation. Like the date of acquisition would have been 1st April 2020, whereas date of consolidation is 31st March 2021. So your date of consolidation is 31st March 21. So we have been given balance sheet on 31st March 21 and we are supposed to do the consolidation procedure. So basically, normally what we are supposed to do is nothing but add all the items of assets and liabilities of the parent and subsidiary, except investment from the parent and net worth of the subsidiary. Net worth is nothing but share capital plus reserves and surplus of the subsidiary. These two items are not to be consolidated, for which we do adjustment. I will just write down the points which you have been doing in the class. So first you do is step 1. You identify the acquirer, yeah, and you find out what is the NCI and all those things. What is the percentage and all those things. Step 2. What is our step 2? So step 2 is nothing but, friends, date of acquisition. When did we acquire? That we write down. Then we write down date of consolidation. This gives us something known as bifurcation between pre and post. So how much of our net asset, that is INA, is pre part and how much is post part? That is our step 2. This is what we do. Then we do step number 3. And step number 3 is nothing but identifiable net asset. See, we are keeping our steps the same what we had. What steps we had for our business combination, the same steps we have kept it here. Here what we do is nothing but we bifurcate it. Pre, post and total. Yeah. So pre, we write down share capital. Then reserves and surplus and any adjustments pertaining to change in the value of assets and all those things. Obviously share capital is always pre. Reserves and surplus, that is equity, pre and post we do. So we bifurcated our this. Now this total is basically on the date of consolidation. This I9 is on the date of acquisition. And this is nothing but between the date of acquisition and date of consolidation. That is nothing but our post INA. Now friends, once we do this, we know what is the parent share. And what is percentage share of NCI. So we get share of parent, we get share of NCI. And basically this is not required only, share of parent. Okay. We just require share of NCI. Now the next point what you would have done is step 4. Once this bifurcation is done, the purchase consideration, whatever is the purchase consideration, generally investment in equity shares by parent. Step 5 is NCI. Now when we write this NCI, what is this NCI? Friends, it is 2. This NCI as well as this NCI, both. So NCI, we say NCI share in pre-INA, NCI share in post-INA. But remember friends, pre-INA, NCI can be either proportionate share of identifiable net assets or it can be fair value. Post will be always this amount, this amount. Post will always be this amount, but pre will be this if it is proportionate share of identifiable net assets. Yeah, and then we get the total of our NCI. Step 5, and then is our step 6. That is nothing but calculation of goodwill or gain on bargain purchase. It is the similar stuff what we had for our 103, nothing but purchase consideration, that is step number 4, plus NCI on date of acquisition. Obviously that we have to see whether it is at fair value or is it at proportionate share. And from with that we deduct INA on date of acquisition. INA on the date of acquisition. What is that INA? This amount I am talking about, friends. This is the INA on the date of acquisition. Share capital plus reserves and surplus. Yeah, pre part. So this we deduct. So what we get is nothing but positive or negative. It may be a goodwill or a capital reserve. That is gain on bargain purchase. This is what consolidation was all about. And then friends, step number 7 was consolidated other equity, or I can say reserves and surplus. So balance of parent plus Post share in subsidiary. From where will I get post share in subsidiary? We will get post share in subsidiary from our step number 3. This is our step number 3. This post share in subsidiary is this amount. Okay. So this is how our consolidation procedures should move on. First, acquirer, how much percentage is your stake? How much is NCI? Date of acquisition, date of consolidation, that will give me a bifurcation about pre and post. And remember, if acquisition is done during the year, my dear students, then current year pre and post will be there. Whereas whatever is opening balance is always pre. Now, then you can make a balance sheet. Very simple. And when you make a balance sheet, that is parent plus the subsidiary. See to it, everything of parent is considered except investment in subsidiary. And everything of subsidiary is considered except net worth, that is share capital plus reserves and surplus. This is how my consolidation procedure works on. We will just do line by line addition of all each and every item. But when you write share capital, that is okay. When you write reserves and surplus, or we can say other equity, we will take this as other equity because that is consolidated other equity. And then NCI from step number 5 we would have got. And then remaining all assets and all liabilities are to be added together. Clear, my dear students? So this was all your consolidation procedures, friends. Now comes adjustment while doing consolidation procedures. What are the adjustments while doing consolidation procedures? That was nothing but my point number 3. Upstream and downstream transactions. Downstream, parent is selling goods to subsidiary. If parent is selling goods to subsidiary, what is the adjustment to be done? Reduce unrealized profit from parent profit and loss. That is nothing but step number 7. And reduce unrealized profit from inventory. That is nothing but our downstream. Parent has sold goods to subsidiary. If it is upstream, subsidiary has sold goods to parent. If subsidiary has sold goods to parent, reduce unrealized profit from subsidiary post P&L. Step 3. In step 3, post P&L will reduce. And obviously the corresponding effect, reduce unrealized profit from inventory. So friends, this is how our working should go. Now, after this downstream, upstream, one more point I would like to add in this is nothing but deferred taxes. What happens is nothing but the carrying amount in your CFS and the tax base obviously will differ. So we need to create deferred taxes. But remember, deferred taxes for pertaining to this downstream and upstream comes only because the adjustment is made in CFS. If you don't make adjustment, there is no deferred taxes. But in CFS, we are making adjustment, but the tax base is different. So it will be made only in the CFS only, not in the SFS of the parent or the subsidiary, because there the cost is same, whatever it is. Here only we are doing adjustment. So deferred taxes are to be done with respect to P&L. Whose P&L, whosoever has taken the credit, that P&L only will create the deferred taxes. Now the third area, friends, and that is nothing but transfer of depreciable assets. In our textbook also we had one question pertaining to Airtel communications and Airtel infrastructure, something like that. Now here when transfer of depreciable asset comes, obviously everybody will say, sir, it may be upstream and downstream. You do the same effect what you have been doing. Why to worry about? I agree with your answer, but friends, what happens if that upstream downstream is happening? If it's inventory, there is no problem. The problem arises when it is a depreciable asset. Because say parent transfers 1 lakh of machinery at 1,20,000. So now in the books of parent, something which was 1 lakh will appear in the books of subsidiary at 1,20,000. So majority of you will say, sir, 20,000 is unrealized profit, reduce unrealized profit. Agreed, no problem. 20,000 is unrealized profit. But say if the question says depreciation rate 10%. So you have to look from the perspective of the group. The asset belongs to us only. If 10% would have been depreciation, then don't you think we would have depreciated 1 lakh? The depreciation that should have been charged to that asset would have been 10,000. Instead of that, we would have charged depreciation of 12,000. So there is something known as additional depreciation which has been charged. So what should I do? The adjustment says deduct unrealized profit of 20,000, of course from parent. Had it been transferred by subsidiary to parent, I would have reduced it from subsidiary. Thus, second, add excess depreciation of rupees 2,000 to subsidiaries P&L, post P&L, and then deduct unrealized profit from PPE 18,000. That is nothing but the net effect. Okay. So transfer of depreciable asset. Remember, whosoever is on the profit, from that profit full amount is to be reduced. Then wherever the asset goes, and because of that, whatever is the additional depreciation, that additional depreciation has affected the P&L. So you should remove that also. Okay, friends. So this is all about your upstream and downstream transactions. Now comes dividend adjustment. What are we supposed to do with respect to dividend adjustment? Now remember, dividend adjustment is not rectification of errors, because the accounting treatment for dividend is credited to profit and loss account. But we are doing this adjustment because what has happened is subsidiary has paid the dividend obviously from pre-profits, and when subsidiary pays the dividend from pre-profits, we are doing this INA calculation in step number 3. Don't you think that step number 3 INA is after adjusting the dividend? And we want to know what is the INA on the date of acquisition. Hence, we have to do the adjustment. So dividend adjustment, I will just quickly revise. What are we supposed to do? 3 things we are supposed to do. Dividend adjustment. Only if it is for pre-dividend. It means dividend has been paid from those profits which have been earned by the subsidiary prior to the date of acquisition. Only if dividend is given from pre-profits, then this adjustment is required. If dividend is not given from pre-profits, no adjustment is required. And remember, this is not rectification of errors. So what are we supposed to do? First of all, reduce parent share of dividend from parent P&L. That is nothing but step number 7. Add total dividend to subsidiaries pre-profits. And third, reduce NCI share of dividend from NCI. This is like company would have given a dividend of 1 lakh rupees. Subsidiary would have paid dividend of 1 lakh rupees, and that too from pre-profit. Subsidiary is accounted it properly. Parent is also accounted it properly. We don't say your accounting is wrong. What we are doing is we are trying to find out what is the net assets on the date of acquisition. In order to do that, what we do is nothing but we add back the dividend to the pre-INA bifurcation. So obviously second corresponding effect, we have to reduce it from the parent share, and we will reduce it from the subsidiary share of dividend. Clear, my friends? So this is what dividend adjustment is all about. Nothing to worry about. Very simple stuff was there. Then comes revaluation. Revaluation, I'll divide it into two parts. We are doing revaluation of fixed assets. Second, current assets and current liabilities. Now, if we are doing revaluation of fixed asset, let us talk on fixed assets. If we are doing revaluation of fixed asset, my dear students, what am I supposed to do is nothing but, first of all, if it is increase or decrease, in case of increase, whose assets are getting revalued? Subsidiaries' assets are being revalued by the parent entity. So while preparing consolidation, parent entity will consider only the revalued figures, and it is not going to consider the book value. So in case of increase in value of fixed asset, obviously the effect is this: add to fixed asset, that is PPE, and add to pre-INA, that is nothing but step number 3. This effect is in balance sheet, and this is nothing but step number 3. We had pre-INA, pre and post, there we will add in case of increase in fixed asset. Now obviously this is going to have subsequently there will be additional depreciation. So friends, how would you account for this additional depreciation? Yeah, deduct from PPE, that is your fixed asset in balance sheet, and deduct from post INA, step 3. This is in case of increase in fixed asset. What can be the second case, friends? Very good. In case of decrease in fixed asset, quickly say what will happen in case of decrease in the value of fixed asset. Superb. Okay, I'll just write it down. Less from PPE and less from pre-INA. Of course, this is step number 3, and this is balance sheet. Now subsequently what will happen? There will be savings in depreciation. Savings in depreciation, add to PPE, balance sheet, and add to post INA. Now remember, this savings in depreciation or additional depreciation, all this will come into picture only if there is a post period. On the date of acquisition only the effect will come on step number 3, pre-INA. Then in the next balance sheet date, on the next balance sheet date, obviously the depreciation in the standalone statements would have been charged normal way. I say subsidiary or value of asset is not 1 lakh, it is 1,50,000, but the subsidiary would have not revalued it. This revaluation is happening only in the consolidated financial statements. Revaluation is not happening in standalone financial statements. Hence, the effect will only and only be in console. Okay, friends. So this was with respect to fixed asset. Then comes your second, current assets. What are we supposed to do for current assets? Now, on the date of acquisition, if current assets are increased, obviously it's increased gain. Current assets and current liabilities, I'll do it together. Increase in current assets and decrease in current liability. What should we do with respect to increase in current asset and decrease in current liability? Simple. Add to current asset or deduct from current liability, and second effect, add to pre-INA, because my net assets increases. Now subsequently, if current assets are realized, and liability is settled, then friends, what should we do subsequently? Very simple. Less from current asset, add to current liability, and less from post INA. Clear, my dear students? Current assets and current liability increase. Now let us move on to the next point in that. If it is decrease in current asset and increase in current liability. Can I say deduct from current asset and add to current liability, and your INA reduces, decrease from pre-INA. Now if subsequently, friends, current asset is realized and current liability is settled, so what do we do? Reverse it off. Add to current asset, deduct from add to post INA. Clear, friends? So this is overall stuff with respect to revaluation. Yeah, you can just check it out. Revaluation. This was with respect to fixed asset. In case of increase, in case of decrease. And then comes current assets and current liabilities. On a single page you can see current assets and current liabilities. Done. So we completed our revaluation adjustments also, friends. Now comes chain holding, triangle holding, which is pertaining to direct method and indirect method. We have two of them. Sixth point. what happens in case of chain holding? You can either follow direct method or you can follow indirect method of consolidation. But for examination purpose, my dear students, you should always follow indirect method. Now, say A is holding some stake in B Limited and B is holding some stake in C Limited. Let's say A is holding 80% stake in B and B is holding say 60% stake in C, which means A is holding 48% effectively. We are not talking about voting rights, friends. We are not talking about voting rights. We are talking with respect to what is the effective holding which A Limited has in C Limited with respect to INA. Now, how this consolidation procedure goes? We will console C Limited SFS and B Limited SFS only. A Limited will console C Limited SFS and A Limited will console B Limited SFS. This is what we do. Now, let us start. What are your workings and all these things we do? So, my dear students, first thing is A Limited in C Limited. Now, how this consolidation works? A Limited in C. So, whatever we had of that steps we will do. Step number 1, identify the acquirer. So, who is the acquirer? A Limited is the acquirer. And what is the stake of A Limited? So, we'll say A Limited holds only 48% in C Limited. So, that means NCI will be 52%. Though I don't hold anything in C Limited, so effective holding is 48%. So, that's why my NCI is 52. Then your step number 2 should be your date of acquisition and date of consolidation. That is normal procedure, though not that important. Step number 3 is nothing but INA. We will bifurcate the identifiable net assets between pre and post. So in that we can have share capital, reserves and surplus and all those things. So that is the normal course of our consolidation procedure. Now friends, step number 4 is PC. And this is very, very, very important area which you should remember for your exam. What PC? So you'll say, sir, how much investment does A Limited have in C Limited? If you look directly, there is no investment. Because A Limited hasn't invested anything in C Limited. A Limited is invested in B Limited. So what we will do is nothing but here we will take investment held by B Limited in C Limited multiply by percentage of stake of A Limited, which is nothing but A Limited is holding how much? 80%. So here my percentage of stake will be 80%. So whatever amount comes, that will be the step number 4. Then comes step number 5, which is your NCI. It will go a basic way out. Pre-share, post-share, or it can be at fair value. Step number 6, calculation of goodwill or gain on bargain purchase. This is what we have been doing. We will continue doing. Only the stuff which is important with respect to chain holding is step number 4 with respect to how much stake does A Limited hold in C Limited. So it's only 80% and that too investment held by B. Then comes next area. A in B Limited. Now here A is having 80% stake in B Limited. So that is not the problem. Here what we will say, identify the acquirer, step 1. So who is the acquirer? A Limited only. So our stake is 80% and NCI is 20%. So this is no problem there. Step 2, date of acquisition, date of consolidation, so that we are able to know what is your pre-profit and post-profit. Step 3, in step 3, that is nothing but INA. Same thing we will do. We will bifurcate the INA of our subsidiary, that is immediate subsidiary, into pre and post. Step 4, PC. No issues with respect to PC. PC is nothing but investment in B Limited by A Limited, held by A Limited. Step 5, NCI, very important. You'll say, what is the important there? See friends, here we write down NCI at proportionate share on identifiable net asset on date of acquisition, whatever it is, plus NCI share in post profits, that is post INA, and less investment in C Limited held by B Limited to the extent of NCI share. So whatever was deducted, if you remember, here important, I had only taken 80%. What about remaining investment? That remaining 20% investment will be eliminated from here, 20%. And this is the amount of NCI which we are going to have in our balance sheet. And then step number 6 is nothing but goodwill or capital reserve. Rest everything is same. No big change. Everything goes in the same way. Only in case of chain holding, we should find out what is the effective holding by the ultimate parent. Indirect method is this way what we do. Clear, my dear students? Okay, while preparing your balance sheet, you have to see to it. What will you do? Sir, all assets, all liabilities, everything to be brought together except investment in B held by A, investment in C held by B, share capital plus reserves and surplus of B, share capital plus reserves and surplus of C. This item should not be brought for consolidation. Rest everything should be brought together. But from our working notes, we have to bring something. NCI, goodwill or capital reserve, as the case may, should be brought in our balance sheet. So friends, this is our 6th point with respect to chain holding. Nothing big stuff we have to do. We just have to see to it that the ultimate parent effective holding percentage has to be considered. That was the case of our chain holding. Now I move on to the 7th point, 7th area, that is triangle holding. Nothing but extension of chain along with the normal holding. Like, let me explain you. Like A Limited holds something in B Limited and also holds something in C Limited, and B Limited also holds something in C Limited. See, here you are holding some 80%. You are holding here say 40%, and B Limited is also holding 40%. Now what are we supposed to do? We will console C Limited and B Limited into A Limited. Now friends, when we are consoling C Limited into B and A, we have to look from the perspective of A Limited in C Limited. Now when you look A Limited in C Limited, what is the stake with what we do in step 1? Nothing but, can I say, direct you have 40% and indirectly you have 32%. So in all, the stake is 72%. My NCI is how much? Nothing but 28%. Once we do this, we will console C in A through direct method 40%, indirect method 32. So now this is our step 1. Then step 2 goes in the same way. What is the date of acquisition? What is the date of consolidation? This step 2 will help us Find out how much is pre, how much is post. Then comes step number 3. In step number 3, what we will do, friends? Very simple again. Identifiable net assets. What are our pre, what are our post, and the total. Share capital, P&L, and all those things, whatever it is. What is parent share? What is NCI's share? And so on. Step 4, PC. Very important. What is very important, sir? Now here, my dear students, you will be having 2 investments. So how 2 investments? A limited 40% and proportionate share in B limited. So here we will say investment held by A in C direct, that full amount. Investment held by B in C. Now when you say B in C, nothing but investment into percentage of stake. What is your percentage of stake, friends? 80%. That amount you'll write down here. So you get your PC, which is step number 4. Then step 5, NCI. Step 6, goodwill or gain on bargain purchase. What we have been doing the same thing. Then comes A in B limited. Now we are consoling what? Once we do see these are all our working notes. These consolidation procedures are all our working notes. This will give us an idea how much is NCI to be shown in the balance sheet, how much is the goodwill or capital reserve, and all those things. Now comes here, friends. We are A limited is going to console B limited. Now what are we supposed to do? Remember, what are we supposed to do? Step 1, that is identify the acquirer, and so we'll say, oh sir, A limited already holds 80%, so NCI is 20%, so no issues. Step 2, date of acquisition, date of consolidation helps me finding out pre-post. Step 3, INA, pre and post. Step 4, NCI. So what will be the NCI? So can I say NCI at the rate of at proportionate share of identifiable net assets on date of acquisition. NCI share in post profits. Wow, you remember? Very good. Less investment held by B limited in C limited to the extent of NCI share. It means whatever that investment was there held by B in C, out of that we are going to deduct 20%. So something is let down. Step 5. Oh, step 4 was PC. Step 5 was NCI, and then step 6, goodwill or capital reserve. Okay, and then of course other equities to be made. So friends, what I am doing is nothing but whatever is there in chain holding, the same thing is there in triangle holding. Triangle holding is not something big stuff, but whatever was there in chain just gets added more in case of triangle holding, because in triangle holding we also bring in the procedures of direct holding and we also bring in the procedures of indirect holding. Combination of both of them is nothing but our triangle holding. So we have foreign subsidiary, the next area of our discussion is nothing but our point number 8. See, it requires application of Ind AS 21. What is a foreign subsidiary? An operation may be a branch, a subsidiary, or a joint venture or an associate, the financial statements of which are prepared in a currency which is other than functional currency of the reporting entity. Okay, So what we are supposed to do is nothing but we have to translate the financial statements of our subsidiary so that we are able to consolidate. And for that, there are translation rates. So what are the translation rates for which the foreign operation is to be translated for? So this is with respect to Ind AS 21 also. Equity share capital will translate at exchange rate on date of acquisition. Then the pre-reserves and surplus, that is also to be translated as exchange rate on date of acquisition. Thereafterwards, friends, we had post reserves and surplus. It is also to be translated at average exchange rate, nothing but all other assets are to be translated at closing rates. All liabilities are to be also translated at closing rate. That is nothing but rates on the date of consolidation. On that rate we will translate. Okay, now I'll just write down the step what we are having for our consolidation of foreign subsidiary. If you remember, step number 1, we calculate goodwill or gain on bargain purchase in foreign currency. First we calculate it in foreign currency, means we find out what is the net assets on the date of acquisition in foreign currency, what is our investment made on the date of acquisition in foreign currency. Based on that we find out what is the goodwill or gain on bargain purchase. Then friends, we move on to step number 2, that is nothing but convert the above goodwill or gain on bargain purchase in our functional currency. Using which rate? Closing rate. Using closing exchange rate. Then the next point is nothing but we convert the financial statements of the foreign operation. Convert the foreign operation financial statements in local currency, or I can say not local but functional currency to be very appropriate, in functional currency as per the rates. Which rates? What we have discussed: assets at closing rate, liabilities at closing rate, share capital, equity share capital at the rate on the date of acquisition, post profits at average rate, pre profits at rate on the date of acquisition. Step 4 is nothing but calculate goodwill or gain on bargain purchase in functional currency based on step 3. Of course, when we convert this foreign operation in financial in functional currency, the difference goes to FCTR, foreign currency translation reserve. And the last step, that is step number 5. The difference between goodwill or gain on bargain purchase as per step 2 and step 4 to be adjusted through FCTR. Okay, So this is what we have been doing with respect to consolidating a foreign subsidiary. Yeah, all your steps on a single screen. Okay, now friends, point number 9. What is your point number 9? Nothing but we are buying additional stake. Now if we buy additional stake, it means already control is there with us. Purchase of another stake, what does it result? See, here you have to look at whether the entry is happening in SFS or CFS, and obviously our here concentration is in CFS. I already had 70% stake. I further buy 10% stake. So my total stake becomes 80%. But I have already done the consolidation because already control was existing. So in SFS your entry is same. Investment account debit to bank, whatever you would have paid. Purchase of additional stake. But in CFS, what is the accounting treatment to be done in CFS? My dear students, you already have the whole INA in your books, because when we console, we call for full consolidation. So the whole INA of the subsidiary is already there in the books. Now what are we supposed to do? Very simple. We will just reduce of the NCI account debit. How much amount? The amount will be nothing but proportionate share. To whatever amount we have paid back. Now comes, what about differencer? The difference arising will be either gain or loss, and this gain or loss should be recognized through other equity and not P&L. Loss and gain, everything goes in other equity. Okay friends, purchase of additional stake. Now this purchase of additional stake, as far as consolidated cash flow is concerned, it will be shown as financing activity. Yeah, this comes under financing activity. Now the next area, sale of stake in subsidiary. In this friends, we have two discussions. Number one, does not result in loss of control. And results in loss of control. Means your control remains as it is. There is no loss of control. Now friends, again, SFS and CFS. If it is SFS, your entry goes in this way. You got the money, bank account debit to investments. And difference here, if any, in SFS will be through your standalone P&L. CFS, what will you do? Same. There is no loss of control. So bank account debit to NCI. NCI proportionate share. Yeah, this will be nothing but proportionate share. Whatever share has increased, that much. This will be nothing but consideration received. Again, there can be difference. This is nothing but loss. Difference is here. It is nothing but gain. Again, what should I happen? Can I say it's through other equity, loss or gain to be recognized through other equity? Now see, my dear students, here again, the sale of investment which does not result in loss of control should be presented in cash flow statement under financing activities. Second, sale of stake that results in loss of control. Okay, so control is lost. So de-recognize everything. In SFS, simple bank to investments, the whole investments which have been sold book value difference. But in CFS, what will you do? De-recognize. What is recognized as far as, sir, we receive money, okay, bank account debit. If investment is held, means there is loss of control, still investment is held, so that investments will be at fair value, of course, in subsidiary. NCI debit, because to INA, to goodwill, and the difference can be here and here. This difference to be recognized through consolidated profit and loss account. This difference will get recognized through consolidated profit and loss account. Clear, friends? Sale of stake that results in loss of control. Now our 11th area, that is nothing but exemption. For parent from preparing CFS. See, you are exempted not to prepare consolidated financial statements in following cases. In following cases means if you fulfill all the following condition. Number first, the parent is wholly owned subsidiary or partially owned subsidiary. And its owners are informed and they do not object non-preparation of CFS. Number 2, it is end. The equity or debt securities of parent is neither listed nor in the process of listing. Whether in India or outside India. Third, the intermediate parent or the ultimate parent prepares CFS as per Ind AS and makes it available for public. So if these conditions are fulfilled, friends, then you need not prepare CFS. One more is there. If the parent is an investment company, just to add up, this is another one. If parent is investment company, and accounts for investment in subsidiary at fair value through P&L, then you are not required to prepare CFS. Okay, this is with respect to exemption, our point number 11. Now I come upon point number 12, that is nothing but investment in associate and joint venture. Friends, let me not talk with respect to joint venture now, because while doing 111, I will be taking care of that joint venture, but 28. Basically, India is 28. Now, India's 28 is with respect to significant influence. If I'm having significant influence, then what am I supposed to do? See, significant influence means I don't have power over the investee. But yes, I participate in the decision making of that investee. And if I'm participating in the decision of that investee, the investments which are held by me are not to be carried at the normal value, that is cost. But those investments are to be carried at an amount which is to be determined based on equity method. We will determine the amount based on equity method. So associate as per India's 28, investment in associates are accounted as per equity method in consolidated financial statements. You will account at equity method. A small example, nothing big in this. Like identifiable net assets of associate is, say, there is nothing but assets minus liabilities is 500. Investment by the investor, say 20%, for which they have paid 150. Okay. INA of associate on date of acquisition is 500. Investment by investor 20% 115, and your purchase rate at 115. INA of associate on date of consolidation is 700. So now, my dear students, what are we supposed to do is nothing but we are supposed to find out what is the value at which this investment is to be shown in the financial statements of our parent entity, nothing but investor entity. So things goes in this way. I'll say whatever we did. Step 1, identify the investor, what is the stake. Of course, here NCI will not come. Step 2, date of acquisition, date of consolidation. Step 3, INA. Now when you say INA, pre and post, and then we have to find out what is our share. So step 1, identify the investor. Of course, we are the investor and we hold 20% stake. Influence is there. Step 2, date of acquisition and date of consolidation. This will help me to find out how much is pre and post. So can I say INA of associate on date of consolidation is 700, date of acquisition 500, which means 200 of INA is post. Step number 3, INA. So here comes bifurcation, pre, post and total. Of course, share capital plus reserves and surplus, everything together, can I say it is 500 here and 200 here, which is nothing but 700. What is share? Share of investor. The share of investor is 20%, which is nothing but 100, and here 40. That is step 3. Step 4, PC. How much did we pay? 115. This is the amount paid by us, 115. Step 4. And then comes step number 5. That is goodwill or gain on bargain purchase. No, capital reserve. Goodwill and capital reserve is only identified but not recognized. Remember, we don't pass any journal entry for goodwill and all those things. We just identify it. So how much goodwill and this? So I'll say, sir, the PC which I have paid is 115. Share in pre-INA. My share in pre-INA is 100, which means how much excess did I pay? Goodwill of 50. Then step 6, nothing but calculation of carrying amount of investment in associate. Now this is the value at which we are supposed to show the associate in CFS. Okay, now see friends, remember goodwill, this is identified. I repeat, this is identified, this is not recognized. We don't pass any journal entries. So we say share in pre-INA, that is 100 because 20% plus goodwill identified. How much is the goodwill identified? Nothing but 15. So what is the cost of investment? Which is 115. And this is the cost of investment which is also shown in our SFS. This cost of investment, what are we supposed to do? So this cost of investment we will just change with respect to changes in the post INA. Now friends, if you look properly, what is the change in the post INA? Your post INA is 40, so it is 200, means it has increased by 200, but our share is only 40. We will add that 40 here, add share in post INA 40. This is the value at which investment will be shown in my consolidated financial statements. Clear till here, friends? Okay, you'll say, sir, yeah, you are adding. So the investment is at 115. We'll be showing at 155. What about this 40? My dear students, this 40 will be added in my consolidated profit and loss account. So what is happening? We just increase the value of an investment and we increase the console P&L. This is how associate works. Okay, so this is all about your Ind AS 28, a small standard there. Now our last area, 13th area, that is nothing but our joint ventures and joint arrangement. See, a joint venture can be accounted as per Ind AS 28 also, and it can be accounted as per Ind AS 111 also. That is nothing but our joint arrangement. Now how that joint arrangement will work, let us work out on that. Joint arrangement. Now a joint arrangement is an arrangement wherein two or more parties have joint control. What is joint control? Contractual sharing of control, which means the decision making pertaining to relevant activities. Requires unanimous consent. Now for examination point of view, friends, see what are we supposed to do. Just look at the structure of joint arrangement. There are two possibilities. Either separate entities form or separate entity is not formed. Separate entity formed separate entity not formed. If separate entity not formed now, then this is dealt by Ind AS 111. And what are we supposed to do as per 111? We are supposed to recognize our share accounting. Recognize share in asset, liability, expense and income in joint operation. So there is no separate legal entity. Separate entity is not formed. Separate entity is formed, mean that you can have two options. Either it is dealt by Ind AS 28 as joint venture, or dealt by Ind AS 111 as joint arrangement. Now, if it is joint venture, then we will be accounting as per equity method. So the investment is, because it is a separate entity, so investment will be shown at the value, which is nothing but adjusting the change in the post INA. And it is 111, then what we will do? Like same, recognize asset, liability, expense and income. Of course, share only, not the whole amount. Now friends, the most important and vital stuff for you. Sir, how we will come to know whether separate entities form it is Ind AS 28 or 111? So there is a flow chart given by our ICI. Let us write it down. In the sense, I'll just revise it off. Does it have the form of the organization or the legal structure is such that the entities are having share in the asset, liability, expense, income, or the contract has been made which gives the venturers the share in asset, liability, expense, income, and so on. So just first, does the entity's legal form gives right to the parties to the asset or liability of the entity? Yes. No. If it is no, then we go for the next question. Does the terms of the contract specify that the parties, that is nothing but the venturers, have rights to assets and obligation towards liability? Again, yes or no. Then the last, does the arrangement is designed in such a manner that the activities provides the parties with output and hence the venture, that is the entity, depends on venturer to settle its liability on regular basis. Yes. If it is no, then the arrangement is a joint venture and to be accounted as per Ind AS 28. Using which method? Using equity method. But if, my dear students, if it is yes, 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 then the standard says what we will be doing. It is a joint arrangement to be considered as joint operation and accounted as per Ind AS 111. As per Ind AS 1, what are we supposed to do? That is recognize share in asset, liability, expense and income. Yeah, friends, so this is all about your Ind AS 111. So overall, this is how our whole consolidation works into 13 areas. Yeah. So my friends, this is the end of our consolidation chapter. Proceeding further, now we'll have another standard. That is Ind AS 102, share based payment. What I plan to do pertaining to this standard is equity settled share based payment plan, cash settled share based payment plan, share based payment plan with cash alternative, then modification and cancellation of share based payment plan, and share based payment plan involving equity instruments of parent. Now friends, what is this all about? Let us, this 102. First of all, the entity has entered into a contract to issue its own equity instruments. And remember, when I'm talking about share-based payment plan, the standard is not restricted only to share-based payment plan towards employee. It is very, very wider. It covers any equity instruments issued for goods and services. Of course, the most important and the vital area is share based payment plan towards employees, because that is the challenging area. So our more focus is on employee part and not on the other part, but that does not mean 102 does not cover that. Yeah, what 102 does not cover is nothing but any share based payment plan which is covered by the principles of 109. That is nothing but wherein net settlement is available. So a share based payment plan wherein net settlement is available is not covered by the principles of 102. Same way, shares and securities issued for goods and services, or for goods to be very precise, assets and all those things in a business combination will also not be covered by the principles of 102. Okay. Now, in case of equity settled share based payment plan. Now, what is an equity settled share based payment plan? Very simple. An equity settled share based payment plan, I'll just abbreviate it, equity settled share based payment plan, is a transaction in which the entity receives goods or services as consideration for its own equity instruments. Now, you have to recognize the share-based payment plan. Now, when I say I have to recognize the share-based payment plan, so the question arises at what value? So, measurement is also there. First, let me talk about recognition and then I'll talk about measurement. Recognition area. Whenever you receive those goods and services, you shall recognize goods or services received or acquired in a share-based payment transaction when it obtains the goods or as and when the services are received. Okay, that is the date you will recognize the share-based payment transaction. So goods will be recognized, services are received, so the service will be recognized, and of course, and corresponding increase in equity. Okay, so this is our recognition. Now comes about measurement part. At what value should I recognize it? So measurement standard says the SBP transaction is with parties other than employees. The SBP transaction is with employees. Now, my dear students, if the SBP transaction is with parties other than employees, then it is to be measured at fair value of goods or services received. If that is not available, then the next option is fair value of equity instruments granted. First option is always fair value of goods and services received. But if it is employee, then the amount at which the transaction should be recognized is always fair value of equity instruments granted. Okay, so we are going to measure the share-based payment transaction at fair value of equity instruments granted. Now, we'll be focusing more on employees part because that is the most challenging area. I hope you remember the entries: employee compensation expense account debit to share-based payment reserve, profit and loss account debit to employee compensation expense. And when the shares are issued, money is received, then your entries bank account debit, share-based payment reserve account debit to equity share capital to security premium. If any balance is left out in share-based payment reserve, then that amount is transferred to, or not is to be transferred, it may be transferred to retained earnings. This is what, friends, you would have done with respect to share-based payment transaction. Now, this share-based payment transaction is nothing but a part of our equity settled plan. Okay, so those are the entries. What you are supposed to do is nothing but you are supposed to recognize the expenses. We are supposed to recognize the expenses over the vesting period, my friends. The expenses are to be recognized over the vesting period. So whatever is the vesting period over that, like it is 3 years, then we will recognize the expense over 3 years. Okay, so this was all about your equity settled share-based payment plan, a basic. Now, friends, in that there were certain things known as conditions. There are conditions that are to be fulfilled. Those conditions can be the condition that you will not leave the employment, vesting conditions, that service period should be completed, and there can be other conditions also. It means which is not at all related to vesting, like you cannot sell the shares after the shares have been vested. So we can say it is non-vesting conditions. Within vesting conditions, I can say service condition and performance conditions will be there. Within performance conditions, some performance condition may be related to the actual performance, and some performance condition will be market related. So that we have to consider while recognizing the expense. We will recognize the expense unless and until allowed to be capitalized. So conditions. What can be the conditions, friends? Two types. Vesting conditions, non-vesting conditions. Non-vesting conditions are not to be considered for all accounting purpose. Of course, in the ratio for determining the fair value, non-vesting condition will obviously come into picture. Under vesting conditions, there were two conditions. Service conditions and performance condition. Under performance conditions, there were again two: market based, non-market based. Now friends, what is this all about? Vesting conditions means you will get the right to exercise the option, because it is an option, only if these conditions are fulfilled. Non-vesting condition means these conditions have to be fulfilled, but this has nothing to do with your vesting. Now these conditions will obviously have an impact on determination of fair value, but nowhere do we consider this non-vesting condition for the purpose of deciding our employee benefit expense. But vesting condition obviously plays a role for the purpose of deciding our employee benefit expense. Like service condition 3 years, so we'll recognize the cost in 3 years. These service conditions may be variable. We say in 3 years, or 2 years or 1 year. So depending on that, we will take into consideration what is that variable vesting period and decide what is the employee benefits to be recognized. Similarly, performance condition. It means particular target, particular level of performance is to be achieved. That performance conditions can be market based or non-market based. Market based means share price should reach certain level, the market capitalization should be this much. This is known as market based performance condition. Now these conditions are not within the control of the employee. Employee cannot control it, and hence whether it is fulfilled or not fulfilled has nothing to do with respect to recognizing employee benefit expense. Employee benefit expense will be recognized in the own way. It means market based performance conditions are not to be considered for the purpose of determining employee benefit. But non-market conditions, like the sales target should be achieved, the profit should be achieved, the percentage of profit increase should be achieved, these are nothing but non-market condition. If it is non-market based performance condition, then they will always be considered for the purpose of determining employee benefit expense. Like number of options, will it be 200, 300 or 400? So if you take the sales to this level, it is 200. If you take the sales to this level, it will be 500 and something like that. So non-market conditions, friends, are also to be considered for employee benefit expense. All non-market performance conditions will be taken care for the purpose of determining employee benefit expense. So now this is what we will be doing with respect to equity settled. Now comes cash settled share-based payment plan. Now friends, what happens in case of cash settled share-based payment plan? Of course, I hope you all remember it. Under this system, the company is going to issue equity shares? No shares will be issued. The company is going to compensate or pay the employees an amount which is nothing but the difference between the exercise price and the market price of the share. That is what we are going to do. That is nothing but cash settled share-based payment plan. A company does not issue any shares to its employee but agrees to pay cash at a later date, which is based on market price. Now, what is the basic difference? See, when it was equity settled plan and cash settled plan, accounting wise, if you look properly, it is employee benefit expense account debit to share based payment reserve. And then, of course, profit and loss account debit to employee benefit expense. This is what you used to do, and share based payment reserve gets accumulated. Under cash settled plan, it is nothing but employee benefit expense account debit to share based payment, not reserve, liability account, and profit and loss account debit to employee benefit expense. Now, under cash settled plan and equity settled plan, what is the primary difference? This amount is predetermined, that is fair value on date of grant. Whatever is the fair value on the date of grant, that is considered. Whereas in the cash settled plan, the employee benefit expense, friends, is not the amount as on the date of grant, but fair value at each balance sheet date. It means the fair value changes in case of equity settled share based payment plan are always ignored. We don't consider the fair value changes of an equity settled share based payment plan, but a cash settled share based payment plan, we always consider the fair value changes. Now, of course, whatever is the fair value, that is recognized as an expense over the vesting period. Difference between an equity settled and a cash settled share based payment plan is that in case of equity settled share based payment plan, employee benefit expense is recognized only during the vesting period because I got the benefits. But if you look at cash settled share based payment plan, my dear students, you will find that the employee benefit expense will be recognized over the vesting period as well as over the exercise period also. Vesting period because benefits are getting consumed, so cost should be recognized. But during exercise period, what happens? The changes in fair values are there. So even the changes in fair values are captured because I have to make a payment. There is my liability and obligation to deliver cash. So this is primarily difference between an equity settled plan and a cash settled plan. In case of cash settled plan, the payment what we are going to make is nothing but the difference between the exercise price and the market value of the share. And that amount is nothing but basically I can say fair value of the particular option. Now, cash settled plan, thereafterwards, we have share based payment plan with cash alternative. Now, what happens in case of a share based payment plan with cash alternative? Now, in this case, the employee has an option either to buy the shares of the entity or to demand cash. You will either buy the shares or you will demand cash. Now, the employee will at the end of the vesting period inform us that whether the employee wants to take the equity shares, then pay the price, that is exercise price, or it wants to go for an option to take cash. That will be informed by the employees at the end of the vesting period. What are we supposed to do? For accounting purpose, we will recognize the expense under both the options, but not full amount. Like 50 rupees is the fair value of cash option and 80 rupees is the fair value of equity option. So we are not going to recognize expense of 80 plus 50, 130. The total expense maximum what can be there, that only will be recognized under both the alternatives. So what we will do is nothing but calculation of equity expense to be recognized. So what we do is nothing but fair value of equity option on date of grant. From that we deduct fair value of cash option on date of grant. So my dear students, what is left out is nothing but excess of equity. over cash option. Now, this excess of equity over cash option, this amount, is recognized as an expense over the vesting period as SBPR. Share-based payment reserve. Whereas this amount is also recognized as an expense as SBPL, share-based payment liability. And this amount is restated at every balance sheet date based on fair values. Okay. So now what will happen is nothing but the share-based payment liability will go line to line with the fair value, whereas share-based payment reserve will be based on the excess amount what has been recognized, and we will be recognizing the total employee benefit expense over the vesting period. Now at the end of the vesting period, if the employee says I want cash, then what we will do? Don't you think your SBPL balance will be equal to the fair value that we will pay? So our entry would be share-based payment liability account debit to bank, and the balance in SBPR may be transferred to retained earnings. But if the employee wants to buy the shares, then your SBPR does not have full balance. Your SBPR, say for example, this was 80, this was 50 at that point of time. So we have recognized SBPR only to the extent of 30. So my dear students, what will you do? So whatever is the balance in SBPL liability account will be transferred to SBPR, and then equity shares will be issued. So this is how the accounting is going to happen with respect to equity settle SBPR, cash settle, and share-based payment plan with cash alternative. Now coming on to the fourth area, modification and cancellation of share-based payment plan. Now remember friends, performance conditions are achieved, not achieved. So obviously there may be change in number of options, there may be change in the exercise price or vesting period in some cases based on achievement of performance conditions. So whatever changes we make, that should not be considered as modification. Modification means change in the contract, change in terms, not arising on account of existing terms and condition. Like your vesting period will be 3 years if sales is this much, your vesting period will be 5 years if sales is this much. So here the vesting period changes, but this vesting period changes on account of existing terms and conditions. We are talking with respect to modified terms and condition change. Now this modification can be what? It can be change in vesting period, increase in vesting period, or decrease in vesting period. Change in number of options, shares which you can buy. Change in exercise price. Now whatever is the modification, increase, decrease, yeah, here increase, decrease, increase, decrease, what? Whatever is the modification, my dear students, remember, if the modification is beneficial to the employee, then that modification is accounted in the books. But if the modification is detrimental to the employees, then this modification is ignored. So remember, modification detrimental means not beneficial. It is beneficial to the employees. If modification is beneficial to the employees, then the standard says, oh, first I'll talk about detrimental, ignore it. Ignore for accounting. And recognize the cost which has been getting recognized normally. But if it is beneficial and employee is going to get more options, the vesting period is reduced, the fair value increases because of this, means in any case the impact of such modification is that employee is going to get some more benefits as compared to the previous plan. Then the incremental cost arising due to modification is recognized prospectively. So whatever is the enhanced cost, that is to be recognized prospectively right from now. Not, say for example, the vesting period was 5 years. We recognize cost for 2 years based on the original grant amount, original grant date fair value. At the end of second year, we modify the terms, and because we modify, it becomes beneficial. We reduce the exercise price, so fair value obviously increases. So the incremental fair value is to be, that is incremental cost, means incremental fair value into number of options, that is incremental cost arising due to modification is recognized prospectively. Now, how to calculate incremental fair value? Nothing but fair value of modified plan, whatever fair value is there of the modified plan, from that deduct fair value of old plan before modification. Of course, on the date of modification, whatever is the fair value. This is known as incremental fair value. This incremental fair value multiplied by number of options, you will get total incremental fair value. This incremental fair value will be recognized as an expense over the remaining vesting period. So in my example, 2 years have passed, 3 years are still remaining. So in 3 years, we'll be recognizing this incremental fair value as your expense. Yeah. So this is all about your modification. Now friends, comes cancellation. Cancellation of a share-based payment plan. Now my dear students, what are we supposed to do as far as cancellation is concerned? Cancellation of a share-based payment plan. In case of a cancellation of share-based payment plan, the employees will no longer receive any equity instruments under the share-based payment scheme. What are we supposed to do? 2 things. First, recognize the remaining amount as employee benefit expense. Whatever is the remaining amount over a vesting period in between, the plan is getting cancelled. So whatever amount has been recognized as an expense, that is okay. Whatever amount is not recognized as an expense should be recognized immediately. So recognize the remaining amount as an expense, employee benefit expense, and compensation paid to employees. If the entity is paying any kind of compensation to its employees on account of cancellation of the plan, then remember, to the extent of fair value of the plan, of course on the date of cancellation, and excess amount. So whatever is the compensation paid to the extent of fair value of the plan on the date of cancellation will be adjusted through share-based payment reserve account. So whatever is the fair value, that much amount, not the fair value on the date of grant. Whatever is the fair value on the date of cancellation, that much amount will be recognized through share-based payment reserve. and any excess amount will be recognized as employee benefit expense in the period of cancellation. Yeah, so we had some 2-3 questions in our textbook also pertaining to it. Now coming on to the last area which you should remember, and that is equity instruments of parent. So share based payment plan involving equity instruments of parent. Now what is to be done in the books of subsidiary and what will be done in the books of parent? Remember friends, parent is under an obligation to issue its own equity instruments to the employees of the subsidiary. I repeat once again, parent entity is under an obligation to issue equity instruments to the employees of the subsidiary entity. So what is the accounting treatment to be done by subsidiary and what is the accounting treatment to be done by parent? Subsidiary entity should recognize employee benefit expense because it is going to get economic benefits with corresponding credit to equity contribution from parent. What should parent do? It should recognize investment in subsidiary with corresponding credit to SBPR, or I can just say to equity. Yeah, so this is what is to be done with respect to share based payment plan involving equity instruments of parent. In the books of parents, it is investment to equity share capital. In the books of subsidiary, it is nothing but employee benefit expense account debit to capital contribution by the parent. Clear friends? So this is all about your Ind AS 102, a very small standard as far as contents are concerned. Yeah, but many practical questions are there which we already have in our textbook. You can just focus on those questions well and enough, this many questions. So friends, let us now move on to another Ind AS, that is Ind AS 36, impairment of asset. Now friends, impairment, a very good standard. Concepts also. First of all, recognition and measurement. Then impairment of a CGU. Impairment of goodwill. Along with that, we should also do the appendix C. Impairment of corporate assets. And reversal of impairment loss. Reversal of impairment. Now, what does the standard talk here? The first area, that is nothing but when should we recognize impairment and all those things. Recognition, nothing but when the carrying amount of an asset exceeds its recoverable amount. When the carrying amount of an asset exceeds its recoverable amount. Then the difference is referred as impairment loss. When the carrying amount of an asset exceeds its recoverable amount. So this is nothing but impairment loss. This impairment loss is to be recognized through profit and loss account. But if entity follows revaluation model, then it will be adjusted through revaluation reserve, provided there is a balance in revaluation reserve. Now friends, the point comes when the carrying amount of an asset exceeds its recoverable amount. So my book value of the asset is 500, my recoverable amount is 400. So 100 is my impairment loss. Impairment loss is to be recognized through P&L. But if entity follows revaluation model, then it will be adjusted through revaluation reserve. Now proceeding further, the next area, and that is, sir, when should we do impairment? Only when there are indicators of impairment. That indicators can be external indicators or internal indicators. The market price of the share has gone down, or I can say the carrying amount of the asset is more than the market capitalization. The market value of the asset has tremendously reduced. There are adverse economic, political, technological changes which has reduced the value. Internal damage has happened. The benefits, or I can say the expected benefits from the asset are less than what we have planned, means the actual benefits are less than what has been planned. These are nothing but internal indicators. So whenever there is an indication, we will test an asset for impairment. Of course, there is an exception to is 3 assets are tested for impairment every year. Which are those 3 assets? Rest all other assets are tested only if there is indicator. Goodwill is tested for, then intangible assets with indefinite useful life, and intangible assets under development. These are the 3 assets, my dear students, will be tested for impairment every year, and rest only if there is an indicators that there is an impairment, then only we will test it, otherwise we will not. Now the question arises, how to find out the recoverable amount? So standard says this recoverable amount is to be calculated based on higher of the following. What is recoverable amount? Higher of the following. What higher of the following? Nothing but fair value less cost of disposal. Fair value less cost of disposal or value in use. So when we calculate the recoverable amount, this recoverable amount is fair value less cost of disposal. Fair value, nothing but 113 definition, the price that will be received on sale of asset or paid on settlement of a liability in an orderly transaction between market participants. So that is the fair value less cost of disposal. So that amount. So of course the standard also gives a guidance for fair value first preference binding sale agreement. If that is not available, then prices in the active market. Within active market, first preference bid price. If bid price not available, then the recent transaction price. If that is also not available, find out what is the best estimate of the amount that is likely to be received on disposal of that particular asset. If nothing is available, then we can say there is no fair value for that asset. Cost of disposal means those incremental costs that will be incurred for disposing that assets directly related to that asset, only that will be considered. Okay, as far as value in use is concerned, my dear students, what is value in use? Value in use is nothing but present value of all cash flows that will be generated from continuing use of asset and the scrap value. All cash flows from continuing use of the asset. So whatever are the cash flows that asset is going to generate, that only we should consider for the purpose of calculating value in use. Nothing else should be considered. One point which I would like you to remember, friends, for examination point of view, remember, for calculating value in use, following should not be considered. Restructuring, restructuring cost to which the entity is not committed, or future capital expenditure. Then financing activities, cash inflows and outflows from financing activities, and income taxes. These are the amounts, inflows and outflows from income tax and financing activities should not be considered while determining value in use. Value in use is nothing but present value of all cash flows that will be generated from continuing use of the asset. You are going to use the asset, so what cash flows you are going to generate, that should be considered. Clear, my dear friends? Now the point comes, sir, what should be the discount rate? Because you are talking about discounting cash flows. Friends, the discount rate should not be weighted average rate. The standard says the discount rate should be a rate which considers the time value of money plus the risk premium. So it may happen that for each asset you may have a different discount rate. When that discount rate is not determinable, then other factors have to play a role, like your weighted average cost and this and that, all those things are there. Clear? So this is all about our recognition and measurement. Clear, my dear friends? One more point in value in use I missed out. For calculating value in use, in many cases you may have that the asset is generating cash flows in foreign currency. So friends, if asset is generating cash flows in foreign currency, then how should we calculate value in use? Very simple. Whatever is the foreign currency cash flow, that should be discounted using the discount rate for that foreign currency. So we get present value in foreign currency, and whatever present value we got in foreign currency, that should be multiplied by the spot rate. So we will get value in use in our functional currency. Okay, friends. So this is all about our recognition and measurement. Let us move on to cash generating unit. How would we consider impairment of a cash generating unit? So my friends, let us move on to the next unit, and that is cash generating unit. Also referred as CGU. Now we were doing impairment of asset, in which we have already completed recognition and measurement. Now we are on the second part, that is cash generating unit. Now friends, normally what we say, whenever there is an indicator of impairment, we should check the recoverable amount with the carrying amount of the asset. If the recoverable amount is more than the carrying amount, there is no impairment loss, but if it is vice versa, there is an impairment loss. That is very cool. But sometimes it may happen that the asset is showing an indicator of impairment, but you are not able to identify the cash flow of the asset which is being tested for impairment. The reason is very simple. The asset does not generate cash flow independently. Yeah, but it is helping us in generating overall cash flows. Like the benches in our JK Shah classes, the furniture. Say for example, there is some indicator of impairment with respect to this furniture. So my dear friends, I would like to test for impairment this furniture, the benches. What is it, fair value less COD? You may be able to determine it. But the next question comes, what is its value in use? Don't you think this furniture itself does not generate any cash flows which is independent? Hence, there comes a beautiful concept referred as CGU. That when I want to test for an impairment of an asset which does not generate cash flows independently, I will bring some other assets or group of assets wherein this group along with the asset which is tested for impairment generates cash flow. This group is referred as cash generating unit. To define cash generating unit, I can say cash generating unit is the smallest identifiable group of assets that generates cash flows which are largely independent of the cash flows generated by other units. Okay, so small point, we can write it down very fast. Yeah, a CGU is the smallest identifiable group of assets that generates cash inflows that are largely independent Now friends, a CGU is the smallest identifiable group of assets that generates cash inflow that are largely independent of the cash flow from other assets or group of assets. So this is all with respect to CGU. Now what would be included in the CGU? A CGU consists of assets that are directly attributable to the CGU, assets that are allocable on reasonable basis, this is my carrying amount of CGU. But remember friends, a CGU may consist of financial assets, financial liabilities, or other assets or liabilities if the recoverable amount, the CGU may consist of financial assets or financial liabilities or other assets or other liabilities like debtors, inventory, creditors, bank loans, provision. It may consist of financial assets, financial liabilities, other assets and liabilities if the recoverable amount is after considering those items. A CGU may consist of financial assets, financial liabilities or other assets or liabilities if the recoverable amount is after considering those items. Now friends, see what we are talking about, that there is one asset which does not generate cash flow, so how to find out its value in use and all those things. So we say let us bring it together with certain assets or group of assets which together are creating cash flows, generating cash inflows that are largely independent of the other CGUs or other assets. Now my dear students, say recoverable amount of CGU is more than carrying amount of CGU. Means this is nothing but carrying amount of CGU. So this carrying amount of CGU is less than recoverable amount. So obviously no impairment loss. Recoverable amount of CGU is less than carrying amount of CGU. Then there will be something known as impairment loss. Now how to account for this impairment? This is recognition of impairment loss. Ind AS says, as per Ind AS 36, impairment loss will be charged to all the components of the CGU in the ratio of relative carrying amount. So question arises, say for example your CGU carrying amount is 500, your recoverable amount is only 400. So my dear students, there is a loss of 100. This loss of 100 will go to which component? There is machinery A, B, C, building is there, everything is there. So our loss will be charged to which CGU? Which CGU means which component of the CGU. So what does our Ind AS say? Ind AS says all of them, and that too in the ratio of their carrying amount, or to be very precise, relative carrying amount. What do you mean by relative carrying amount? Nothing but a carrying amount multiplied by useful life. Subject to the conditions that impairment loss will be charged to all the components of the CGU in the ratio of relative carrying amount, subject to the condition that the revised carrying amount of asset cannot be reduced below number 1, 0, number 2, value in use, and number 3, fair value less cost of disposal. Of course, this too if determinable. Done, my dear students. So if I have 3 components, out of which one component fair value is more, then I cannot charge impairment loss on that particular component, because individually it is more than its carrying amount. Then it will be reallocated among remaining CGUs. Again, subject to the condition that after charging impairment loss, the carrying amount of CGU cannot go below 0, value in use or fair value less COD. So there can be a scenario wherein there will be some amount of impairment loss that remains uncharged or unallocated to the component of CGU. That is very true. Okay. After CGU, friends, let us move on to the next area, the third area I can say, goodwill, impairment of goodwill. Now, goodwill will arise because of business combination. Now, goodwill comes in our books on account of business combination because Ind AS 38 does not allow recognizing self-generated goodwill. So, friends, we get goodwill in our books on account of Ind AS 103, where we say it is nothing but excess of PC, purchase consideration, and this is your identifiable net asset share. So, whatever is the excess of PC over and above the identifiable net asset share, that is known as our goodwill. Now, this goodwill is to be tested for impairment every year, irrespective of whether it has shown any indicator of impairment or not. Now, if you look properly, my dear student, you will find that goodwill itself does not generate cash flows that are independent. It does not generate, but obviously it provides synergies to acquirer CGU that generates cash flows. 1 plus 1 is more than 2. That synergy effect is available to the acquirer. Now, so the standard says goodwill acquired in a business combination should be allocated from the date of acquisition to each of the acquirer CGU or group of CGU that are expected to get benefit from synergy of business combination. Irrespective of whether asset or liability of acquiree are included or are assigned to those units. So, goodwill what will you do? It will be allocated from the date of acquisition to the each acquirer CGU or group of CGU that are expected to get benefit from synergy of business combination. Now, how goodwill will be charged? How impairment to goodwill will be charged? It depends on whether the goodwill is relatable and allocable or goodwill is relatable but not allocable. See, you cannot test goodwill for impairment independently because independently the goodwill does not generate any cash flow. So, you have to bring it along with certain CGUs. So, obviously goodwill has to be related. This goodwill is relatable and allocable, or goodwill is relatable but not allocable. So, let us discuss that area, how impairment will happen with respect to goodwill relatable and allocable, goodwill relatable but not allocable. See friends, I'll just do the working here. is relatable and allocable, is relatable but not allocable. Here goodwill is allocated on reasonable basis. Goodwill is not allocated. Now, what does the standard wants us to do in case of impairment of goodwill? It says in the first part here, check impairment loss on individual asset or group of asset. First you should do this of CGU. If impairment loss, then charge such impairment loss to individual asset or group of asset. Once that is done, friends, second, perform impairment test for goodwill by adding it to each CGU, of course, to which it relates to. If recoverable amount of the CGU is less than the carrying amount of CGU, of course, which is including goodwill, then charge impairment loss. Now, my dear students, when you charge impairment loss, you will charge this impairment loss first against goodwill. So, first we will write off the goodwill and thereafterwards against remaining component of CGU in ratio subject to condition. What was the condition? That after charging impairment loss, the revised carrying value of the asset should not go beyond zero, value in use or fair value less COD. I think I should give an example here, how it should go. See, my dear students, we have X, Y and Z, 3 CGUs are there and their carrying amount is there, say 500, 300 and 800, and there is a goodwill which is 1000. Now, this 1000 is allocable on all this X, Y, Z on some reasonable basis, say 3:3:4, some reasonable basis. Don't worry, how did I get that? That is assumption. So, how impairment loss will be taken care of? Standard says first identify whether any individual asset or group of asset is showing any indication of impairment. If yes, then impair it first of all. Impair, like X is showing impairment, then just impair it off. Then what to do? Then it says X, Y, Z. Carrying amount, assuming it is 500, 300 and 800. Then the goodwill 2:2 or say 300, 300 and 600. Oh no, sorry, 400. So what I will get is nothing but carrying amount of CGU, which is including goodwill, say 800, 600, 1200. I have to compare this with recoverable amount. Say recoverable amount is 300, 700, say 1000. Then the question arises, what is the impairment loss? How much will be the amount of impairment loss? How much against goodwill and how much against CGU? So if you look properly, my dear students, in case of Y, there is no impairment loss, but here the impairment loss is 500. Out of that 500, the full amount will go against goodwill and remaining 200 will go to CGU. Here what will happen? How much is impairment loss? 200, and the whole impairment loss will be charged against goodwill. Got the point? So simple. Of course, it means there will be some goodwill which will be left out. Now, how much goodwill will be left out? 300 plus 200, that is 500 rupees of goodwill will be left out. Now, this is with respect to when goodwill is relatable and allocable. Now, here we say goodwill is relatable but not allocable. So, what does the standard say? Standard says first you check. Check whether any CGU is having indication of impairment. See, on the left hand side what we were doing? Here we used to say on the left hand side basically this check the asset or group of asset. Here we say check the CGU only. If impairment loss, then charge such impairment loss to that CGU, of course excluding goodwill. There afterwards what should we do? Perform. Perform impairment test for goodwill by adding to the carrying amount of all CGU. If recoverable amount of CGU is less than carrying amount of CGU, then charge impairment loss first against goodwill, then to CGU on pro rata basis. Now, I did one example. Let me do one more example pertaining to this XYZ only 500. We have goodwill of 1000. Now, this goodwill is relatable. It relates to XYZ, but it is not allocable. You cannot allocate it on reasonable basis. Then what should we do? Very simple. First we will test XYZ is showing a sign of impairment on its own. Let's say the answer is no. So I will do X 500, Y 300, Z 800 and goodwill 1000. So can I say we have 2600. Now friends, let's say the recoverable amount is say 2000. This is total carrying amount. Recoverable amount is 2000. So therefore, impairment loss is 600. Where will this impairment loss go? Obviously against goodwill. So whatever is the amount of goodwill, we will write it off against goodwill. And if goodwill is less than the loss amount, then it will go to XYZ on pro rata basis. Okay. Now friends, the next point which is very interesting area, appendix C. Now what is this appendix dealing with? NCI at proportionate share of identifiable net assets. This is what the area we have to discuss. Of course, it gets related to business combination only, but we can have an idea with respect to it. Now friends, in this appendix C to Ind AS 36, NCI at proportionate share of identifiable net asset, what is there? So dear students, what is there is nothing but our institute has given us guidance that as per Ind AS 103, we can recognize NCI at proportionate share of identifiable net assets or at fair value. If NCI is recognized at proportionate share of identifiable net assets, then the goodwill that gets recognized is partial goodwill. But if NCI is recognized at its fair value, then the goodwill what we get is total goodwill, full goodwill method. So there were two methods, full goodwill method and partial goodwill method. So here, my dear students, I would say that NCI is at proportionate share of identifiable net asset. So what is the problem and what is the resolution given by our institute? It's not a problem but a challenge. It is like if an entity measures NCI at proportionate share of identifiable net asset on the date of acquisition, then goodwill related to NCI is included in recoverable amount of the CGU, but is not recognized in parent's CFS. But obviously, because we went for partial goodwill method, and if we are going for partial goodwill method, my dear students, what happens is we will only show the goodwill to the extent of our share and not NCI share. But when we are calculating the recoverable amount of the subsidiary, don't you think the recoverable amount will obviously be calculated with respect to 100%? So there is a mismatch. This mismatch is to be resolved, and that resolution comes in appendix C. So what is the resolution? It says as a consequence, the entity shall gross up the carrying amount of goodwill allocated to the unit to include goodwill attributable to NCI, which I will use the word notional goodwill. This adjusted carrying amount, which is including goodwill, is then compared with recoverable amount to determine the impairment loss, if any. It's not necessary to always be there. This is what we do. What I will do is, friends, I'll just make a small example for you, so it becomes easier for us to get connected. Say A Limited, that is a parent, acquires 80% of another entity, we'll say subsidiary, for rupees 2100. On date of acquisition, the INA is 1500. NCI is at proportion share of INA. Now my dear student, the first task is to find out how much is the goodwill, and that too at proportion share. So what I can say is nothing but purchase consideration 2100. What is the share in INA? Our share in INA, because the INA is 1500, but 1500 is for the whole subsidiary. We are just buying 80%. So 1500, 80%, that is 1200. So my goodwill is 900. Okay. Let's assume the above goodwill is allocated to parents CGU and subsidiary related CGU. So here it is 500, here it is 400. And the recoverable amount of subsidiary CGU is 1000. At the year end, not now. The carrying amount of subsidiary CGU excluding goodwill let's say 1350, just for understanding. This is question. You may just look at the whole question. Okay, my dear students. Okay. Now, moving further, what will happen? If you look properly, there is a resolution. Carrying amount of subsidiary CGU 1350 plus allocate goodwill. What is the allocable goodwill? 400. So 1750. And what is the recoverable amount of the subsidiary? Is 1000. Now my dear students, if you look properly, when I say recoverable amount of the subsidiary as a whole 1000, that is 100%. This carrying amount of the subsidiary CGU, which here are showing, can I say 100%? Because we will show the whole subsidiary in our books. We don't show 1200. 1200 is just our share, but we will be showing the full subsidiary at 1500. INA will be always be full. That's why we will have NCI. But this 400 is only pertaining to 80%. So now, what we should do? Don't you think this is uncomparable? To make it comparable, don't say recoverable amount will be reduced. We will just add notional goodwill. How much? See, 400 is 80. So can I say 20% of notional goodwill 100? So I will be getting total carrying amount. So now friends, we will get an impairment loss of 850, which is nothing but 1850 compared with 1000. So we have an impairment loss of 850. Now this impairment loss of 850 will be first charged against goodwill and then to the CGU. So how much will go to goodwill? So whatever amount of goodwill we have goodwill of 400 plus 100, that is 500, and the remaining 300. So this will be towards the subsidiary CGU. This 500, 400 will be towards parent's goodwill and the remaining 100 will be towards our notional goodwill. But remember my dear students, the journal entry will be only with respect to 750 because I am going to recognize only the loss which pertains to me. The notional goodwill is not there in my books. So it will be impairment loss account debit 750 to parent goodwill. We don't say parent goodwill, but just for our understanding, 400 to INA of subsidiary, which is recognized in our book, which is 350. Now, this is the end of our Appendix C to Ind AS 36. Now friends, impairment of corporate asset, it is similar only, nothing big in this. So now corporate assets will be impaired. Now corporate assets are nothing but divisional assets, ADP, head office asset. These assets do not generate cash flows independently, but obviously they help us in overall management of the business, operating activities of the business. So what does our AS say that we should allocate these corporate assets? So it says corporate assets are assets other than goodwill Corporate assets are assets other than goodwill that contribute to the future cash flows of both CGU under review and other CGU. What the example I gave? Nothing but divisional assets, electronic data processing, equipments that are equipments, head office building, research centers and all those things. And remember my dear students, corporate assets do not generate cash flows independently. So now what should be done for impairment loss with respect to corporate assets? So we will just divide it into two parts. Can corporate assets be allocated on reasonable basis? Answer will be yes and no. Somewhat of similar to what we did for goodwill. Of course, in goodwill we said relatable and allocable, relatable, not allocable. If it is yes, then what should we do? Compare the total carrying amount of CGU along with corporate assets with recoverable amount. If recoverable amount is less, then the impairment loss will be charged first against goodwill, remaining impairment loss on pro rata basis, including corporate assets. So, corporate assets will also be taken on pro rata basis, means it will be considered as a component of our CGU. If it is no, then compare the total carrying amount of all CGU along with corporate assets with its recoverable amount. If recoverable amount is less, then impairment loss will be charged. Of course, here also same, against goodwill and remaining impairment loss on pro rata basis, including corporate assets. I'll just show a small example so that the things you will be able to remember it. Say for example, we have CGU X, CGU Y, CGU Z, say 500, 300 and 800. I have corporate assets, 1000, just what we did for goodwill. Let's say corporate asset is allocable. Then what we will do, X, Y, Z, carrying amount 500, 300, 800. Add corporate assets, assuming this corporate assets is 3, 3 and 400. Now my dear students, 800, 600 and 1200. Let's say the recoverable amount is 1000. 500, 1000. Then there will be impairment loss. Where? Here no impairment loss, here 100, here 200. This 100 impairment loss will go to corporate assets as well as the carrying amount of CGU in the ratio of its carrying amount. Similarly, this 200 loss will also go to corporate assets and the carrying amount of CGU in the ratio of 8:4. Simple. Now, in the same example, if I say corporate assets are not allocable. So, here what we will say is X, Y, Z and corporate assets. We will take all of them together. X, 500, 300, 800 and my corporate assets of 1000. So, it is 2600. This carrying amount will be compared with its recoverable amount. Whatever is the loss will be in the ratio of 5:3:8:10. Clear, friends? Okay. So this is all about our corporate assets impairment. Now my dear students, I will move on to the last area of our discussion, and that is nothing but reversal of impairment loss. One point you remember, increase in value in use due to afflux of time, passage of time is not reversible. So your cash flows are 100. Earlier you used to discount something by 9, say 9090. Now the same thing which was discounted earlier by 9090 will now be discounted by 1 because it is today. Earlier what was discounted by 8264, assuming 10% is the discounting rate, now in the next year it will be discounted by 0.90. So what happens, because cash flows are same, but the cash flows which were considered this year and the next year, it may lead to something like increase in value in use. This increase in value in use, just because of passage of time, should not be considered as reversal of impairment loss. Now my friends, we were talking with respect to this impairment, that a reversal should not be considered to be increase in value in use due to afflux of time. Now I will divide the discussion in two parts. Case 1, reversal of impairment loss, 3 cases basically. In case of individual asset. Now my dear students, remember, this impairment loss reversal may happen because of, again, indicators, internal indicators or external indicators. Whatever was there at the time of charging impairment, same type of indicator, discount rate has reduced, there is not adverse but favorable technological and economical changes and all those things, market value has increased, my market cap is now more than my net assets and all those things. These are the indicators. I would have abandoned the plan of discontinuance or restructuring and something like that. So these are indicators. Now if there is an impairment of an individual asset earlier, if we are reversing it off, if the impairment loss was charged to P&L, then the reversal will happen through P&L. If the impairment loss was charged to revaluation reserve, then the reversal will also be through revaluation reserve. Okay, but what should we remember, that when we charge an impairment loss, we should see to it that the revised carrying amount of the asset does not go beyond something. Okay, I'll just make it a small note here. The amount of reversal should not exceed, number 1, actual impairment loss. Whatever impairment loss you have charged, it should not go beyond that. Number 2, after reversal, the revised carrying amount of asset should not exceed what it would have been had impairment loss not been charged. Say for example, I had an asset which value was 100. I charged some impairment loss in that year. So impairment loss of 40 was charged, so value was 60. First year depreciation I would have charged, assuming 10% rate, say 6 SLM, so I am having 54. Again depreciation for second year after impairment loss has been charged, say 6, so now my value is 48. and there is reversal. Say the carrying amount is now 70. So you will say, sir, okay, 70, so 48, I have to take it to 70, that is nothing but 22 I can increase. Standard says, yes, you can increase 20, nothing wrong in that. But had you not charged impairment loss, what would have been the carrying amount of the asset? You just look at that, it cannot go beyond that. Maximum reversal. So, like, had I not charged impairment loss, can I say I would have depreciated 100 at 10 rupees? So, it would have been 90, again 10, 80. It means in any case, whenever I reverse, what is the maximum reversal I can do is restricted to 80. I cannot go beyond 80. Only 32 can be reversed off. Of course, here I said 70, I can reverse off that amount because it does not go beyond 80. But if I say the revised carrying amount is 90, no, you can't. It cannot go beyond 80. So, this is our first part, that is reversal of impairment loss. Recoverable amount is now increasing as compared to its carrying amount. This is what with respect to first part. Now, case 2. Reversal of impairment loss in case of CGU, of course excluding goodwill, but including corporate assets. It's very simple. Say now CGU. So you have component A, B, C plus corporate assets, carrying amount is there. And now what is happening? The recoverable amount is more. But earlier I had already charged the impairment loss. So standard says, of course, you will reverse it off, but subject to condition. The reversal of impairment loss for a CGU should be allocated to all the assets on pro rata basis. Subject to following conditions. Now, what are the conditions, beta? First, reversal cannot exceed actual impairment loss charged. The revised carrying amount of asset after reversal should not exceed the carrying amount what it would have been had impairment loss not been charged. See, similar to individual asset what I did. Third, the not reversal but the revised carrying amount cannot exceed fair value less COD of course for these two if determinable. This is with respect to impairment loss on our CGU including corporate assets, because corporate assets are also considered to be component. And the last and the most important, reversal of impairment loss in case of goodwill. What if impairment loss in charge against goodwill? Remember, as per Ind AS 36, impairment loss charge against goodwill cannot be reversed under any circumstances. No reversal permissible, whatever be the case. See, under AS 28, goodwill reversal permissible was there, because under AS 28 it says, if the condition for which you had charged impairment loss, that condition does not exist, then you reverse it. But under Ind AS, such kind of stuff is not available only, my dear friends. It clearly says impairment loss charge once cannot be reversed off in any circumstances against goodwill, to be very precise. Yeah, so my dear students, I have completed all the 5 areas which we had planned for discussion with respect to impairment. Even this year RTP, November 23 RTP, also considers the concept of appendix C. So I would suggest you to go through that RTP part also,